continue sowing doubt in the results enough that Republican lawmakers in some of those states will feel like, gosh, no one knows who won. We need to step in and appoint the electors ourselves. That strategy is also massively flawed from a legal, a constitutional, and an ethical standpoint. But it's also not going to work. That's not going to happen either. But the point is as long as he has some belief that there's some lever he can pull, the president is not going to give in on this. So we're going to just play this out. I think that has consequences for, as you noted, the coronavirus vaccine, the economy, all kinds of things.
Ryan, thank you so much. Ryan Teague with a briefing there. Really a confusion almost on this Thursday on the Washington debates. There is no confusion. It is always informative to listen to Loretta Mester of the Cleveland Fed. She is prodigious in the dynamics of our monetary policy. Jonathan Farrell, Michael McKee in conversation in the 9 o'clock hour. An important interview. Futures at -12. This is Bloomberg. Good morning.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. Thank you for being with us. Futures at -13. Dow futures at -119. Right now, we want to talk to Mark Chandler, and it's a different conversation. He writes exceptionally thoughtful books about the state of our international economics. He has a wonderful book linking it in to the astronomy and indeed the astrology of the moment. And he joins us from Bannockburn today. Mark, you called up Bloomberg and you said, look, let's make a smart FX index. I'm appalled. We have DXY. We have U.S. trade-weighted major. We have Asia DXY. Thank you, JP Morgan. We have the Bloomberg Dollar Index, and now we have the Chandler Index. What have you wrought?
Well, I think that the Bannockburn World Currency Index is different than the other indexes because it's based on GDP. These other indexes are like the dollar index has very little to do with what's going on in the world. You know, two of the U.S.'s largest trading partners, Mexico and China, are not even in the dollar index. I don't think it's in the Bloomberg dollar index either. And so I think that what we wanted to do was come up with a index that's more representative of the world as it exists now and also flexible. For example, the U.S. economy, the largest in the world, is about 30% of it, the weighting, while China and the Eurozone are both about 20%. And that's the interesting thing that's going to happen this year, Tom, is that the Chinese economy is going to surpass the Eurozone's economy, move into the second largest in the world. And so its weighting will be enhanced. And the Chinese really like this because you look at what's in the SDR. You know, the Chinese yuan is in the SDR, but it only has about, say, about a 10% weighting or so. In the GDP weighted index, and it's a nominal GDP, it is closer to a little bit over 20%.
Well, your index, I'm going to suggest, gives a radically different picture. And folks, for those of you not part of Global Wall Street, this is a huge deal, really going back to the 19th century, which is how do you bundle in all these pair relationships? It's a really serious issue. Do I read it correctly, Mark Chandler, that we've had a weak dollar policy since 2011, and right now we've got a modest dollar rebound? That's counterintuitive, isn't it?
Yeah, no, so what I think our Bannockburn World Currency Index is showing is that the world's currencies are actually appreciating against the U.S. dollar our index rises. That's really the world rising against the U.S. And I think earlier this week we set 2-year highs, which sort of mirrors, in a sense, what's happening to the other, what's happening to the major currencies. And the other interesting thing about our index is that half of it is the emerging markets and half of it is the developed economies. And there's a debate about who should decide what's an emerging market. Should MSCI decide? Or isn't the Chinese currency significant enough to be part of the majors? And so we wanted to have a basket. Again, it's not so parochial about these divisions.
Mark, good morning. So actually, a lot of market participants and HSBC, the new chief research person, put a renminbi in the G10 space. Should it be there?
Well, I don't know. I don't know really what that really means. I mean, you've got a guy at HSBC who was an emerging market strategist who now became overall strategist. And of course, he wants to still be watching the China. As I tend to focus on the major countries, and of course, I think that China is a major country, but so is South Korea, so is India. And so I think that we don't want to get too caught up in what's emerging markets, what's G10, what's G20. I think it's important that we just recognize that the power in the global economy is more diffused, and countries like India, for example, look like they could surpass Britain and France to move into 5th place in the world economy this year.
All right, but Mark, renminbi, can it actually become a reserve currency at some point and replace the dollar?
Well, I don't know about replacing the dollar, but Francine, it already is a reserve currency. It's just a small part, about 2%. And what central bankers say is that over time, they want to increase it to about 5%. Is it going to challenge the dollar? I don't think so. I don't think that the markets are transparent enough. I don't think that that they are not only transparent, but that they still seem to be, here's the challenge really for people, is that China has a huge trade surplus. It has capital inflows that it gets integrated into global capital markets, and yet the reserves haven't grown, and the currency doesn't seem to be reflecting the full strength of these inflows. And so people suspect, like we all know, that the Chinese currency is heavily managed, even if the exact particulars we can't quite identify. I know there's people who are talking about China is about to eat America's lunch, but China isn't even a dominant, isn't even a hegemonic power in the region. And so I just think that we in the United States like to often think that some country is chasing us, whether it was the Soviet Union, whether it was Japan in the 80s, and now we think it's China. And I think that's just really about the U.S. lack of self-confidence.
You know, Mark, one final question. I do think this is really, really important. On this index, I love the idea that it's GDP weighted. What is the service sector goods/commodities dynamic within the math of your GDP weighting?
Well, that's a good question. I think that the key here, I think, Tom, is that countries as they develop, like in the U.S., the service sector is so much larger than the manufacturing sector in terms of employment, in terms of GDP contribution. But you look at a country like India, for example, and the agriculture is still about 50% of the GDP. And so I think that's what I try to do, is try to pick up how these countries evolve. And as they shift from agriculture to manufacturing, and then from manufacturing to service, I wanted to have an index that is really representative of those flows. So I do recognize, to your point, that as the highly industrialized economies become, as they develop, the service sector grows, the agricultural sector shrinks, and the manufacturing sector shrinks. I think it's interesting too that you note this, that our CPI measures, our inflation measures combine the deflation in goods and the inflation in commodity prices. And so we're really stuck with this. Sort of it's like that old story about the guy whose head is in the oven and feet are in the freezer, and his average temperature is okay.
Thank you so much, Mark Chandler there at Bannockburn, Chief Market Strategist, and you can, of course, find that index at BWCI on the Bloomberg terminal. Now, joining us again from the Bloomberg New Economy Forum, we have a number of world leaders. We also have a couple of people that really have moved the needle in technology stocks. We'll be speaking to Ruth Porat. We'll also be speaking to Mike Wells of Prudential. You can watch it live on Bloomberg. That's on all of our social platforms, on Bloomberg.com, on the terminal, and on TV. This is Bloomberg.
went to Baltimore, you went initially to be an anchor woman, and then it didn't quite work out.
Yeah, I got fired.
Well, you
got demoted. I was
demoted, but they didn't. They had a contract, so they didn't say goodbye. Yeah. And then, how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know with age and perspective, that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25." Then you're 30. So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000. Right. So they kept me on and said, "We'll put you on this talk show just to run out your contract."
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. I'm Rishika Gupta with your Bloomberg Business Flash. Job security on Wall Street didn't last long. The pandemic pause of layoffs just kicked the cost-cutting can down the road. Big banks are ramping up job cuts as their CEOs feel the pressure from investors. Goldman Sachs and Wells Fargo have imposed modest cuts, but 2021 is expected to bring larger ones. Delta Airlines will keep blocking middle seats through the first quarter of the next year. The carrier wants to reassure passengers about the safety of aircraft cabins. Delta's decision bucks an industry trend. Rivals have begun selling those middle seats again. And it's another sign of how the coronavirus pandemic has upended Hollywood. Warner Brothers' Wonder Woman 1984 will premiere on HBO Max the same day it appears in theaters in the US, December the 25th. The movie debuts internationally 9 days earlier. HBO Max subscribers will have a month to watch Wonder Woman at no additional cost. And that is your latest Bloomberg Business Flash. Francine.
Ritika, thanks so much. Global stocks are slumping for a third day, focusing on coronavirus restrictions. I'm also looking at some of the European stocks, and they're really declining with a broad base. I'm looking at cyclical shares. They're down. I'm looking at, for example, Norwegian Air, ThyssenKrupp, two of the biggest fallers in European trade, Tom.
In the 6 o'clock hour in America, churning to the market. Again, I note gold down $15, $18.59. The ounce. In the equity markets, a little bit of weight to the tape. Right on the screen, yes. Futures, negative 16. An important conversation. Sebastian Mallaby will join us, the Council on Foreign Relations, of comments made by Dr. Kissinger on China and on the ghosts of World War I. Please stay with us through the day as we celebrate Bloomberg New Economy Forum. This is Bloomberg Good Morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
The
explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
The American administration is about to change, but the clock will not simply be rewound.
There's been more external aggression and more internal repression. So that's just a fact.
He's inheriting a relationship with China that's going to be fraught for the foreseeable future. We got to give the new administration a chance to articulate an approach.
We all want to work together with the U.S.
The key is, how do you have competition and keep it healthy?
The big challenge with China is to get what I would call a strategic framework.
Let's set it some basis for some cooperative action.
There's great opportunity for the incoming president.
The world will slide into a catastrophe comparable to World War I.
A set of world leaders speaking, and trust me, they listen to Dr. Kissinger. He made world headlines here at our Bloomberg New Economic Forum by drifting back to the history he knows, coming out of a war-torn pre-World War II Europe. Henry Kissinger, of course, over to America, but with a global perspective, including recent books on China and on our world. The perfect person to discuss these themes, Sebastian Mallaby, joins us with the Council on Foreign Relations. Interesting in that Mr. Mallaby is definitive not only on finance and the hedge fund world, but has a passing understanding of our international relations. Sebastian, what is so interesting here is so many of these challenges over time come to us as a surprise. Did we really know that World War I was coming, as Dr. Kissinger alludes to? Did we know that World War II was coming and what we have now? Do we have a visibility of what's coming with a modern China?
Gosh, that's a great question. I mean, I think, the First World War was more of a surprise than the Second. If you watch the rise of Hitler in the 1930s, the Second World War was pretty well telegraphed. And it's the First World War that was a surprise, as I say. I think now, the debate over China is really, can you escape this Thucydides trap where the rising power, China, inevitably bumps up against the world order created by the United States, and the two just can't reach an accommodation. And I think until, let's say, 2017, it looked as though there was a good chance that China could be bound into the global system peacefully. But in 2017, both countries turned nationalistic. Make America Great Again faced off against the Xi Jinping speech when his first 5 years in office ended at the Party Congress, in which he said, there was an era of rejuvenation for China, and he sounded a lot of nationalistic notes in that speech for more than 3 hours. So I think that's the turning point, 2017. And now the question is, with a new president coming in, what are the odds for resetting that?
Sebastian Mallaby, part of this is a renaissance or an affection that President Xi has for the past, of returning to a China and the international dynamics that we saw generations ago. Do we need to do the same thing? Do we need to turn back to the realpolitik of Dr. Kissinger, or is there a new way forward as we address China?
Well, in some sense, Trump has been a representative of a kind of slightly wacky kind of realpolitik. He certainly doesn't believe in permanent alliances. He's been trashing those all over the place. So he's he's certainly not an idealist, if that's the normal juxtaposition to realpolitik. I think what we need to go back to is a sort of sense of being tough, having realpolitik, recognizing our interests, recognizing they're not the same as China's, but at the same time being more predictable and consistent with respect to our allies. The big mistake in the Trump years was not so much taking on China, because I think the rise of China poses a real challenge. It was the way it was done. It was done without first lining up European support, without making sure that you had the rest of Asia on your side. If you pull out of the Trans-Pacific Trade Partnership, which was your way of binding in Asia into a US-led alliance, it puts you in a weak position vis-a-vis China. So I think it's an alliance-based realpolitik.
How will China, Sebastian, good morning from London, how will China work with the Biden administration?
Well, I think China is the ultimate practitioner of realpolitik. They absolutely do not seek to question who's in power in the other country. They just get on with it and deal with whoever is in power. So I think their instinct will be to try to make the best of it. But, fundamentally, we are in a different place to where we were before 2017. It's also because of the technology shifts that have happened, right? We've had a world in which artificial intelligence in some measures has gone ahead in China over where it is in the United States, and technologies like drones. The Chinese are ahead. DJI, the Shenzhen-based drone maker, has 70% of the world market, but is viewed by the Pentagon as a threat. So it's not just the famous 5G clash. There's a whole bunch of these tech areas where China is a challenger, and that challenge has a military application if we're talking about AI or drones. The next generation of warfare will be software. Software is not just eating the world, as Mark Andreessen said, it's eating warfare too. And I think in that scenario, the US needs to get tough. China's not going to like that. So this is going to be a tough relationship to manage. And as I say, the key is to be tough, but to be predictable and to take allies with you.
Sebastian, how much more influence can China actually exacerbate through, debt relief on certain economies? They hold a huge amount of debt, and this is a conversation that we don't often have. And so when you talk about debt relief for certain emerging economies, it's really going to be possibly a political decision from China.
Yes, that's true. There's a lot of leverage that China has accumulated by being the world's greatest saver for a long time and then exporting those savings. And that would be no surprise if the Chinese did precisely what the United States did for most of the post-war era, using both its own lending, but also its influence over the multilateral lenders, the World Bank and the IMF, to get Cold War goals accomplished. And so I think China will try and do the same thing. And it'll have an effect, but not on the central countries. We're talking about influencing vulnerable states in places like Africa, maybe the southern periphery of Europe, Greece perhaps. We're not talking about influencing the core NATO countries.
Sebastian, one of the great moments where you and I sobered up is how wrong we got our intelligence on Gorbachev's Soviet Union. We just had our knowledge of the Soviet Union at the time. We were just off the mark. Do you have confidence in our intelligence of the government in Beijing?
That's a good question. I think the mistake, in a way, with the Soviet Union was not so much misreading the leaders, although there was a bit of that. It was more the fragility, the internal fragility of the country.
Yes.
And the economy. And if you look at China, the economy is much less of a closed book than the Soviet one used to be. There were no real prices at all in the Soviet economy, whereas in China, you can debate some of the prices, but basically there are real signals, and there's a ton of market participants who are invested in China, who are, compensated heavily to get some of those readings on the Chinese economy roughly right. So I do think we know a huge amount more about China than we used to know about the Soviet Union.
Sebastian, I want to turn to your expertise on finance. We've been talking international relations, but you have some definitive work on alternative investments, on the idea of hedging and taking a fee and taking a profit on the fee. I'm surprised I haven't seen you on Billions or one of those fancy TV shows where you telling everybody what to do or questioning the certitude of the Hollywood actors. What's the state of the hedge fund industry right now?
I think fundamentally the problem with hedge funds right now is that they get paid to measure risk. And when central banks have dampened risk across the board, compressed spreads, you just get paid less for doing the same work of risk assessment. So I think that's the underlying problem with hedge funds. From that follows also a need to rethink the compensation model a bit. I think 2 and 20 is one thing when the risk-free rate is 5 or 6. It's a whole different ball game when if the risk-free rate is 1, but I'm wanting 2 just for a management fee. That's a bit steep. So I think there are problems with hedge funds. In some ways, I think what you've seen, and this links to the book that I'll be publishing next year about venture capital, what you've seen is that the world shifted from yield seeking through hedge funds to yield seeking through tech investments. And so the huge flood of money into late stage growth technology investing, which you saw most extreme with the Vision Fund of Masayoshi Son. But that's been a big shift, and you've had a bit of a bubble in late stage tech financing, as we saw with WeWork and things like that. But fundamentally, some of the, I think hedge funds are a less exciting place to be today than they were a decade ago.
Sebastian, what's your take on Brexit? I know that, I guess Boris Johnson has to decide on three things, which is a level playing field, on fisheries, but also on governance. Do we know what he'll do and how that will actually change the course of the UK?
Well, there was a sort of revealing moment a day or two ago when it was revealed that David Frost, the chief negotiator for the UK, had himself predicted before he was in government that the UK would wind up caving at the end of the negotiation. So we'll see if the UK does that again. It does seem crazy that something like fisheries, which represents sort of 0.1% of GDP or whatever, should be the real stumbling block in a negotiation. It seems crazy that the Conservative government, which since the time of Margaret Thatcher has believed in not having state aid for companies, having a level playing field, keeping the government out of subsidies, that the desire to give subsidies should suddenly be the breaking point. So I hope there'll be a deal to be done, but we are running out of time. I think, by the way, that, beyond that, there's going to be a big reckoning for the UK. I just saw numbers today that the economic performance, negative 11% on GDP, will be the worst in 300 years by some measures. The UK's relative performance in the G7 before Brexit was pretty much number one for a few years. Now it's slipped to number 7 out of 7. So I'm quite worried about the UK economic outlook.
All right, Sebastian, thank you so much. The good thing is that Tom knows all about UK fisheries right now and the EU. He studied the maps. He has them at home. Sebastian Mallaby, their Council on Foreign Relations, Senior Fellow for International Economics. Now let's get straight to the Bloomberg First Word News with Ritika Gupta. Hi, Ritika.
Thanks, Francine. The Trump administration has assured states they'll have enough hospital beds and equipment to handle the surge in coronavirus cases. But it's not doing anything to slow the virus's spread. And the Trump team continues to shut out Joe Biden's advisors. Vice President Mike Pence says the media have been crying wolf about the disease. The job picture in the U.S. has gotten worse as the number of coronavirus cases rises. According to the Census Bureau, the number of employed Americans fell by about 4.5 million from mid-October to mid-November. Amongst the jobless, 4.2 million said they were sick with coronavirus or caring for someone with symptoms. In New York City's prospects of recovery from the coronavirus face a double whammy. The subway system could be crippled by big budget cuts unless Washington comes to the rescue. Plus, public schools are ending in-class instruction for at least 2 weeks. That's forcing parents to find alternative childcare arrangements or adjust their work schedules. And European Central Bank President Christine Lagarde is promising a monetary stimulus package for next month, and she's urging Eurozone leaders to do their part.
The next generation EU package must become operational without delay. This is critically important.
Lagarde says European leaders should make joint fiscal support a priority. Europe is expected to be severely affected by the rapid increase in coronavirus infections. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Ritika, thanks so much. Now, coming up next, Joshua Sharfstein. He's Johns Hopkins Bloomberg School of Public Health Vice Dean. We talked to him about restrictions. We talked to him about COVID-19 and the Oxford AstraZeneca vaccine. This is Bloomberg.
expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
This is Bloomberg Surveillance. I'm Francine Lacroix here in London, Tom Keane in New York. Now, as we continue tracking the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Joining us today is Joshua Sharfstein. He's Johns Hopkins Bloomberg School of Public Health Vice Dean. Dr. Sharfstein, thank you for joining us. We had encouraging news, not only from Moderna this week, but now from AstraZeneca and Oxford, and yesterday Pfizer. How close are we in terms of timeline to actually having a vaccine that reaches a number of critical people so that there's herd immunity?
Well, the first step is to validate the results of these studies and to have them reviewed by the regulatory agencies. That should happen pretty quickly if the data is as strong as it seems that it is. An effective, safe vaccine is really urgently needed because of just the explosion of cases in the United States and also recently in Europe. I think that if the review goes well, that the doses could be moving by the end of the month or into December. Now, to get to the point of herd immunity, you need a lot of people vaccinated, so that'll probably be into the spring and summer of next year.
How much do we know about how long the protection lasts through these vaccines?
We don't know very much. I mean, people have been vaccinated for about 2 months. And obviously the protection seems by report quite robust for that period, but we don't know how long it'll last. Now, we will know how long it will last because the companies will keep following the people in the vaccine, and that'll allow us to get updates about what happens to them. So it's possible that people may need boosters, but, you know, we'll have to see. I think based on what we know about people who've been sick with the virus, it's probably at least a period of several months, which of course could be still very, very helpful for the pandemic.
I mean, is it different because of the type of vaccine? So we could see different results from, you know, between the AstraZeneca one and Oxford one compared to the newer ones, which are, you know, Moderna, Pfizer, because they're mRNA type vaccines.
Yeah, there are not that many vaccines that are made like the AstraZeneca vaccine either. So I think we don't know, and it could be different, and that's why we, you know, keep collecting data to find out. I mean, we're going to have to go sort of one step at a time through the vaccine process. The first step is really making sure that these vaccines have a strong safety record and are very effective, and looking at the data for different signals in different groups for effectiveness. I think the most recent data for the AstraZeneca vaccine was focused on a strong immune response among older adults. We're hearing that the Pfizer and maybe the Moderna vaccines also had very good results for older adults, which is even better than a strong immune response. And that's really great because it's older adults who face the greatest risk of serious illness and death from coronavirus.
Are we going too quickly? Is there a danger that if this gets approved too quickly, even if it's safe, not enough people will want to take the vaccine?
Well, I think there are a couple factors. I think that we're going to see a serious review by the U.S. Food and Drug Administration, and they've pledged to bring in independent advisors to look at that data. So people will then get a chance to really look at the data. A lot of that will be released publicly. The FDA a couple days ago just made a special commitment to transparency, which I think will be very helpful for people's understanding of the process. There'll be a committee at the Centers for Disease Control. So we'll start to see these processes play out, and they really have two roles. They validate the data, but they also give confidence. Then there's the broader question of acceptance, which really will have to do with a bunch of different things. It will have to do with whether people can get their questions answered and whether vaccines can really get to the point of contact with people. You know, imagine a low-income senior housing complex somewhere where you have a lot of people who really need the vaccine but can't get it. You know, now you might look at that and say, well, you know, they can't drive, get on a bus and go across town to the place to get it. Well, that's not fair to them. We really need to make sure we can bring the vaccine to people who are very vulnerable to COVID-19. And if we can do that, I think we'll see, if we combine that with a smart outreach strategy, listening to people, bringing in local leaders, I think we'll be able to be successful.
Joshua Sharfstein, thank you so much for joining us of Johns Hopkins there. And be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our great conversations with Johns Hopkins experts for an inside look at battling COVID-19. Now, coming up on simulcast, Patrick Foy, MTA Chairman and Chief Executive. That's coming up in about an hour and a half from now. 8:30 a.m. in New York, 1:30 p.m. in London. And this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there's a Google problem in this country.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. The city of Phoenix has approved a slate of incentives for Taiwan Semiconductor's planned $12 billion chip plant. Phoenix will provide about $200 million to develop roads and other infrastructure. Getting TSMC to build the factory in the U.S. is a step towards addressing national security concerns about the industry's supply chain. Boeing's recovery is now riding on the world's most infamous jetliner, the 737 MAX. How quickly the plane maker rebounds depends in large part whether airlines and travelers warm up to the MAX. U.S. regulators have cleared the plane to fly again. It was grounded for 20 months after 2 fatal crashes. And American home buyers are putting up the biggest down payments in 20 years. The median down payment for single-family homes and condos was almost $21,000 in the third quarter. That's up 69% from a year earlier, and the most in records going back to 2000. Lenders have tightened mortgage standards, plus home prices have skyrocketed. And that is your latest Bloomberg Business Flash. Francine?
Ritika, thank you so much. Now, this is what the markets are looking at. Stocks actually slumping for a third straight day. Again, a tougher coronavirus restrictions, not only in New York, but in many parts of the world. And that's fueling concerns about the pandemic's economic toll. In Europe, I'm looking at a decline that's pretty much broad-based, with cyclical shares taking the brunt of the sell-off. I'm looking at ThyssenKrupp down, Norwegian down. Norwegian is seeking protection from creditors. Germany's ThyssenKrupp said they would slash 11,000 jobs. Plus, we're just getting some breaking news out of Macy's. This gives us a good indication of U.S. retail. They say that in comparable sales, they're down some 20%. It's a bit better than expected. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
worse place today than we were in the first half of October.
We've seen a massive momentum shift in the last week that we don't think investors should be ignoring.
You're not going to get a continuation of this straight upward movement. There will be pullbacks.
In the very short term, we are very much due for a tough time.
The Fed has been quite clear that they expect the federal government to hopefully provide more income support.
What they really want is for Congress to do its job, and that's not happening.
This vaccine news is game-changing. It gives us a bridge to somewhere for policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. As we count you down to the opening bell, equity futures slightly negative. Tom Keene, the brutal reality of the here and now, catching up with the hope of 2021.
Well, you see it across the board, and it's going to be interesting. John Golub yesterday at Credit Suisse to see the 2021 look forwards. All we have, John, is good conversation and to look at the tea leaves. Lisa's going to talk about jobless claims and all the rest of it and the churn of the market. But I want to look at the granularity. Macy's moments ago is a pandemic stock. Stock's off 7%, John. And there's the reality, which I believe you mentioned yesterday. I can't remember which property you mentioned it on, but you mentioned it yesterday. You know what? Retail's really struggling.
Well, Tom, this is a story. A stock like Macy's has done pretty well over the last week, but that's the difference between a catch-up trade off the back of the positive vaccine news and a durable trade that goes beyond 2020, beyond 2021. We've got a really tough journey ahead of us, and I think that's the story for the next couple of hours on this program. A tough journey. We understand the destination, whatever normal is, with a vaccine. I get it. But before we get there, Tom, we've got to get through the next couple of months. And the path so far is really clear. More restrictions and New York City dominating the news flow in the last 24 hours.
I mean, it's a comedy. Vet Bill brought it to my attention, John, but this is not funny. In South Australia, you can now not walk your dog because of pandemic fears and all that. And it buttresses, John, off of the sort of macro Davos talk of, say, Bloomberg New Economy Forum and the realities that Lisa, frankly, has been talking about here day by day. How about this? 250,000 deaths. That gets your attention.
Yeah, and initial jobless claims over the coming weeks will get your attention as well, Lisa.
Yeah, and this is something that really goes to your point, John, about the difficult here and now. My question is, how much more permanent scarring are we going to get as a result of the difficult journey in the weeks and months ahead? 8:30 a.m., as Tom predicted, I'm going to talk about it. I am talking about it. U.S. initial jobless claims, they are expected to actually decline slightly from last week. But really, what we're looking at is the number of firings. In other words, how many businesses are just simply shutting down as we see those virus numbers climb. 8:45 a.m. John, you were talking about New York City. It has become the epicenter of this story, and we are going to be talking about the dire situation for the public transit situation. MTA CEO and Chair Patrick Foy joins us here on Bloomberg Television. They are facing massive cuts to service, firings of many employees because they have not gotten that federal aid that they need, that $12 billion they said they need to plug the gap. And today we have the final day of Bloomberg New Economy Forum. We're going to be hearing from Moderna's Stefan Bancel again, the promise of the biopharmaceutical response to the virus in the forefront, Bill Gates as well, and Alphabet CFO Ruth Porat. It'll be interesting to see what the new reality is for big tech, John, given the fact that so much hope has been baked in to the stock prices and to the stay-at-home trade.
Speaking of hope, let's get to the price action of this morning. Thank you, Lisa. This Thursday morning, we shape up as follows. Equity slightly negative. We bounce back a little bit on the S&P 500. We're down just 3 points and off by 0.1%. It's about the relative outperformance and underperformance beneath the surface. Small caps on the Russell outperforming the NASDAQ by 8-9 percentage points since last Monday. It's been about where you are long, not just being long, Tom. In the FX market, euro dollar down to 118.37. And in the bond market, it's been a big story for us over the last week. Yields up to 97 basis points, new high end of the trading range. Yields back down, all the way back down to about 85. So 0.8537% is your yield on the 10-year. And the story has not changed. The questions we are asking have not changed. 2021 could be better, but it's a tug of war between the back end of 21 and the reality of the here and now, Tom.
Yeah, the reality here is that the bond market, I looked at some of the support levels today, and we're not in on yield yet to where support gets broken, but it's something worth watching day after day. Let's get up to speed now, John. You've got a wonderful guest that can meld all this in together.
We've got a wonderful guest. Keep the faith, trust the recovery. Andrew Sheets of Morgan Stanley joins us now, Chief Cross-Asset Strategist. Andrew, let's just start there. That's your latest research. Keep the faith, trust the recovery. How much will that faith be tested in the coming months?
Yeah, thanks, guys. Good morning. Look, we're clearly in for a very difficult winter. Cases are heading up. We think economic data is going to slow as a result, certainly in the U.S. And I think very importantly, you have had a lot of sentiment measures in the market become a lot more optimistic post the election, post some of this vaccine news. And so that also needs to get worked off. But, ultimately, I think these are very short-term issues for the market, not longer-term issues for the market. I think this is about kind of limited pullbacks, and I think pullbacks that ultimately are going to get bought by the market, because I do think that investors will look at, weakness over the next couple of months as maybe their kind of last best chance to position for a more normalizing, stronger recovery in the year ahead. And as worrying as it is that I think a lot of investors have gotten a lot more optimistic post-election, I think in terms of the actual amount of money that's been deployed into the market, the actual shifts in real investment approaches, I think those have been a lot more muted. And so I do think there's more of that rotation to do as people look into next year.
Andrew, one of the great proxies here is the VIX. We talked to Dean Kernick yesterday. VIX 41 into a stunning 21.22, right now 23.57. That's a measurement of uncertainty. What's the next uncertainty? What's across your asset classes at Morgan Stanley? What's the next great mystery out there?
Yeah, so I think there are, a few things that we need to watch. I mean, I do think there is some uncertainty about just how much the market has internalized the rise in case counts that we'll see in the U.S. going forward. And I do think this is also where a global perspective is necessary, because the U.S. case counts do look like they will continue to get much worse. And you obviously have a catalyst with Thanksgiving to continue to accelerate that process. But cases in Europe are looking like they're stabilizing. Cases in Asia are on a very different trajectory. So, I think that yes, the virus case count is a very, here and now issue, but it's also somewhat more of a U.S.-focused issue, I think, in terms of how we see those numbers evolving. I think we also have some key government deadlines. We have funding deadlines coming in the middle of December to avoid a government shutdown. Our belief is that the market's expectations on further fiscal stimulus are low, so that the disappointment from anything there would be modest. But I think that's another uncertainty the market would like to get through.
Andrew, you say keep the faith, and you say there are all these uncertainties in the near term, but longer term, it's looking bright. Bond markets are not buying the optimism. You could see yields that are trending lower. Yield curves are flattening. You could see break-even rates coming down. This does not bode well longer term. It does not seem to fit with the narrative that many people are offering up to go into these cyclical stocks at this point. Who's got it wrong?
Yeah, so I think that's a great point. I do think what we're seeing in bond markets is inconsistent with our story of a stronger recovery next year and a cyclically led recovery. And so, our view is we think the bond market, those bond yields will adjust higher, rather than the cyclicals and the equity market ultimately adjusting a lot lower over the next 12 months. I do think that this is about getting through the winter peak. Our analysts think that peak in U.S. cases could come sometime around kind of late December or early January. I think once you can see kind of the downward slope of U.S. cases, I think it will be a lot harder for U.S. yields to potentially hold the current levels. Also, I think if we just think about the arithmetic for next year, Ellen Zentner, our U.S. economist, has U.S. growth at around 6% next year, and we have a U.S. 10-year yield at less than 1. I just think that would be a very difficult equilibrium to hold, especially as you have wider spread availability of the vaccine and continued improvements of data. So bottom line, look, it can make some sense that uncertainty is supporting bond yields for now, but I think this might be the best support that those yields get, because this is the most uncertain things we'll get. And as the closer we get to kind of January 1st, the more of that support starts to fade away.
You guys are bullish. You're looking for 145 on a 10-year next year. We'll hear from Matt Hornback at Morgan Stanley in a few hours' time. on another one of my programs. Tom loves the teasers. Looking forward to that catch-up with Matt. Tom, experience here, I think, is really important. The experience of spring. And I just wonder whether the lessons that we learned from spring are the right lessons. We had the shutdown in New York on, what was it, March 13th? 10 days later, the market bottomed. The market bottomed when the Fed stepped in and started buying high-yield credit. And I just wonder, Tom, whether that's the right lesson, the degree to which we've been conditioned by spring, and maybe why some people just refuse to sell risk going into a dark winter.
I mean, Andrew, I don't know if you're still there, but this is really critical. To John's point, is the Fed going to stun us with action?
Well, yeah, I think it is. I don't think the Fed will stun us with action, but I think the Fed will remind us that it's still there, that the Fed is still providing liquidity. And I think this is a really critical difference with some past cycles. A reason why we don't think, a reason why we think the bond market is wrong is we do not think we're heading to a Japanification scenario, because we've had a far more aggressive fiscal and monetary policy response than we ever saw in Japan. And so I think the fact that the Fed is there, the Fed has reduced some of that tail risk, the Fed can kind of help with that bridge to the spring. I think that's very important for keeping equity corrections to kind of the single-digit level rather than the double-digit level.
The constructive outlook from Andrew Sheets and Morgan Stanley. Andrew, thank you. Tom, I was talking with Guy Johnson yesterday about the bill that might need to be paid here, and I think typically we ask that question with a narrow answer. We think about it as if there's going to be some huge sovereign default. The way I think about it, if you add a ton of debt to an economy, your tolerance for higher interest rates is greatly reduced. The dynamism around that economy is also diminished because you're keeping bad companies, so to speak, alive to some extent. We've all talked about the zombie economies, and I think for that reason, it's pretty understandable to expect trend growth to be lower. It's pretty understandable to expect inflation to be lower. Isn't that the kind of story we need to be thinking about?
Yeah, absolutely. I don't know if Lisa's still there, but frankly, Lisa, it's about the debt and the deficit, isn't it? I mean, it hasn't affected the United States.
I'm still here, and I will say, John, that's exactly the point, the sort of low growth going forward. That's exactly the point that the central bankers have been making, that their outlook has not materially changed as a result of the vaccine.
Keep the faith. We've got no faith in Lisa's ability to put up with us for as longer than 10 minutes. Is she still there? 12 minutes into the show.
Did she run off the set? Yes.
Coming up in the next hour, Pat Foy, the MTA chairman and CEO. Looking forward to that. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. Joe Biden warns that the delay in starting the presidential transition could set back the efforts to distribute a coronavirus vaccine. The General Services Administration has refused to begin the transition process whilst President Trump challenges election results. The leaders of the National Association of Manufacturers is urging the Trump administration to begin working with Biden. In Wisconsin, election officials have ordered a partial vote recount that was requested by the Trump campaign. There will be recounts in 2 heavily Democratic counties. Joe Biden won Wisconsin by more than 20,000 votes. Recounts have historically shifted only hundreds of votes. And the controversial nomination of Judy Shelton to the Federal Reserve Board is hanging by a thread, and there's little chance it will be revived. The Senate is preparing for its Thanksgiving recess. Once lawmakers return, Democrats will be picking up another seat. That makes confirming Shelton an even tougher battle. And the UK and Canada are on the brink of reaching a post-Brexit trade deal that would avert each side imposing tariffs come January the 1st, when the Brexit transition period ends. Bloomberg's learned that an agreement could be announced within days. And the city of Phoenix, global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I have no budget. I can't do any of this until I'm sworn in, or I can convince the president now to do things that should be being done already. I mean, there's hardly been a meeting that's taken place in the White House about any of this.
The pressure intensifying just a little bit from the Biden side. That was President-elect Joe Biden there on the transition process. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Let's touch base on the price action this Thursday morning as we count you down to initial jobless claims 1 hour and 12 minutes away. Add an extra 60 minutes to that. We head into the open. Equity futures are down 4. We're off by 5. Call it 0.1%, down on the week by about 0.5% coming into Thursday. In the bond market, Treasury yields nicely behaved, coming down a basis point to 0.857%. And in foreign exchange, in G10, dollar stronger against everything. In EM, dollar stronger against pretty much everything, with the exception of the Turkish lira. Dollar lira taking a dive. The lira stronger. Tom Keene, a 475 basis point hike from the Turkish central bank.
I don't want to spend a lot of time on it, John, but it was widely signaled, and of course there it is, and we did see stronger lira. We didn't see it out to the extent of 2 standard deviation and some of the other technical indicators. But yes, strong lira, but in the context of massive depreciation, it was just a good day for Mr. Erdogan. Right now, Kevin Cirilli joins us from Washington. We could talk about U.S.-Turkish relations, but we can't do that. It's just Cirilli channeling Roy Orbison this morning. Kevin, I want to talk about only the lonely at the White House, which looks like a fundraising concern. I want to cut to the chase. Is all of this angst that we're seeing about the president raising money?
Anything you want, Tom. Look, I think in terms of fundraising, it's really going to come down to whether President Trump wants to try to make a calculation beyond the January 5th runoff in Georgia. And I was speaking to sources yesterday, and they're telling me that they are still, the president and his inner circle is still trying to figure out what their long-term objectives are. Is it to get in the game for 2022? Is it to get in conservative media circles? Is it to run for re-election or to play a kingmaker of sorts in 2024? All of that is unknown. But I will tell you this, that in just a few weeks, on December 11th, when the continuing resolution is set to expire here in Washington, D.C., that could be the last opportunity that this president has to really shake up something with Congress. And Mark Meadows, his chief of staff, was on Capitol Hill yesterday. This is the final point I'll make. Meeting with Senate Majority Leader Mitch McConnell. After that meeting, he said he couldn't guarantee that there wouldn't be another government shutdown.
Okay, well, the government shutdown. I mean, what is the president's advantage of doing a shutdown as he's packing his bags?
Well, this would be the third government shutdown in his presidency,
Yes.
should there be one, the last one having lasted more than a month. In terms of what it would mean should he do this, it would be an opportunity for there to be a fiscal fight, potentially over stimulus. This as Republicans are divided in terms of the scope of another round of stimulus.
A government shutdown when parts of the country are locking down. Kevin, what happened to the Senate yesterday? Where are they now? And how long are they gone for?
Well, they're gone at least until after the Thanksgiving holiday, and then they come back for that continuing resolution fight around December 11th, Jonathan, and you're absolutely correct. I mean, look, the positive developments on the vaccination front, this despite the surge in hospitalizations over the past couple of weeks, not just in the United States, but around the world. And of course, what's been going on in New York City, a clear illustration front and center right now in terms of what not only people are having to face from a schooling perspective, but also from a public official and public employee perspective with transportation employees. So all of this is really amplifying the debate in Washington. But as you just alluded to, they're not going to be here for at least another week.
Well, Kevin, let's build on this. The idea, you said it's amplifying the debate. Is it? Is there a sense of urgency? And it's not just New York City. This is very important because we talk so much about New York City, but frankly, the cases are spiking in the central part of the United States. This is a real issue across the nation. Is there no urgency?
Well, you know, I think that's a great point. Yesterday, I spoke with Congressman Trey Hollingsworth, a Republican from Indiana. Indiana would have like the 35th worst COVID rate per capita in the world. So it's hitting the heartland just as much as it's hitting that, according to the Indianapolis Star. It's hitting the heartland just as much as it's hitting the cities. And to your point, in terms of the urgency, it is, but they're dug in. That's what's so fascinating about this. Is the positive. This is the positive developments on the vaccination front are having Democrats urging for there to be more stimulus, and Leader McConnell and Republicans saying that it's the fourth quarter.
Yeah.
So to ride it out. So they're dug in, and there's not compromise.
You know, dug in, Tom, it reminds me of what Jamie Dimon of JP Morgan said yesterday. He said it's ridiculous. $1.5 trillion, $1 trillion, $2.5 trillion. Just split the baby and get something done. Is that what we're heading toward, or can they not split the baby, or are we not dealing with a Solomonic time?
Kevin, answer the question. I mean, where are we on stimulus if Jamie Dimon says it's chump change?
Well, look, I think the Business Roundtable, by working with the Biden transition team, is sending some clear signals that they're playing the short-term game in terms of what's next on January 21st. And so they're already laying the groundwork in terms of how that's going to look. I was struck by Senator Lindsey Graham yesterday, Tom, a Republican from South Carolina, who essentially said that the President Trump ought to be briefing on national security as well as on coronavirus with President-elect Joe Biden. He didn't refer to him as such, but it was a clear indication that there can still be lingering questions in the courts while also briefing the transition team.
John, are you still with us?
I'm still here. I'm standing by. I haven't left. I've come close many times, though. Much closer than Lisa's ever come. Kevin, it's great to catch up. Kevin Cerilli, I'm pretty sure I've walked out a few times, and management's brought me back in. That's happened, I promise you.
Go on.
Kevin, thank you. I'm not going to go anywhere. Do you want me to tell you more of the story? Is that what you're asking for?
Yeah.
Lisa?
No,
I don't think anyone needs to hear that.
Morning.
I just think
Tom and I have had some blow-ups in the past, I think it's fair to say, behind the scenes. I'm not sure that's going to be a surprise to anybody.
Tots and
Back in the day when this program wasn't on screen as well, Lisa, a few years ago when this was just on radio, I could step away and then management could pull me back in and push me back into the studio, and now I don't have that
but the
luxury
problem,
anymore,
John, is when you get your litter and your entourage and you're going down Poultry Street, management can see you trying to make your exit to Mayfair.
This
that's
is the reason why John is carried to set. We figured it out.
It is. You got it right.
That is right.
And they take his
Kicking and
badge away
screaming.
from him.
Kicking and screaming. Lisa, I think what you did about 3 minutes ago was really important. There's something quite New York-centric about some of the conversations we have sometimes, and largely because of markets. And what I thought was really interesting yesterday, Tom, is just how the market responded to New York schools shutting down, the public school system shutting down. The market actually responded to that as if that was a surprise. As if it had to be New York to wake up to what was happening in the rest of the country.
I'll give you an anecdote. I know a guy who did a master's at Washington University in St. Louis, and he correlated natural gas prices with the temperature at the subway entrance to Wall Street. It's a 76% correlation. 76
there you go.
R squared.
That's everything you need to know.
That's all you need to know.
There's something very
It's
New
all about
York-centric
New York.
about this market.
It's just all New York.
Absolutely.
Yeah, and
Alongside
London,
Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, here in London and in New York. Coming up on this program, Lisa Hornby, Schroders Investment US Fixed Income Portfolio Manager. She'll be joining us very shortly, and I promise we will all still be here. Heard on Bloomberg Radio, seen on Bloomberg TV. I can't make promises for Tom.
Yeah,
I never can. This is Bloomberg Surveillance.
Better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
New Economy Forum brought together over 600 leaders to discuss the most pressing economic issues facing the world today.
Join us as we recap the important conversations from the week on our New Economy Forum special this weekend on Bloomberg Television.
From London and New York, this is Bloomberg Surveillance, and here is the price action. The questions of the last week, they haven't changed. How much confidence do you have in 2021, and how much bad news are you willing to tolerate? How much bad news will it take for that confidence to come undone? Here's the price action of this Thursday morning. Equity futures declined by about 0.1% on the S&P 500, but the story of the last week or so is about the spread between the S&P 500, the Nasdaq, and the Russell. So let's take the Nasdaq and the Russell. Since last Monday, 7 to 8 to 9 percentage points of outperformance on the small caps relative to big tech. It's not about where you're long at the moment. It's about which pocket of this market you sit in specifically, not at the headline level, at the sector level, at the style level. Small caps over big tech has been a massive story. Switch up the board and get to the bond market. I want to talk about treasuries very briefly. 2s, 10s and 30s. Top end of the range last week, 97 basis points on a 10-year. We just can't get back to those levels. The drip feed of vaccine news over the last couple of days, not enough to give this a lift. It's about the data, and the data in 60 minutes' time will be driving this market, I'm sure. Yields coming a basis point to 0.8586% on a US 10-year. Let's finish things up with foreign exchange. In G10 and in EM today, the dollar more broadly showing some real strength against G10 and emerging markets, with the exception of this one right here. Dollar lira has had a 10 percentage point move since November 6th, largely because of the churn at the central bank. A new central banker coming in, 475 basis point hike, dollar lira down to 757. That is a stronger Turkish lira. But here's the story, Tom. That's the first move. That's not enough to get back and reclaim central bank credibility. You need to do more than just move once. This is going to be about a story of accumulating that credibility over time. Today was the first step.
Yeah, I'll agree with the first step idea. From a 757 level, folks, I see it down to 725 is where they really need to get before they see a real turnaround. Right now on yield, and on the bond market, Lisa Hornby with us with Schroeder Investment out of Barclays and out of the wonderful economic program, the really prodigious economic combine at Rutgers as well. Lisa, I want to go to that Econ 101 concept of elasticity, and that's the dynamic of yield. We're in a new yield regime, supposedly. When you see the movement of yield, full faith and credit day to day, is it a new elasticity or not?
You know, it's funny. Yields are as low as they are. People are doing their 2021 forecast saying, where can things go from here in the U.S.? And we did some work looking at European yields. Obviously, we started this year at much, much lower yields, and yet Bund delivered returns of plus 20% year to date. So, you know, you look at a very low yield environment and you say, is there any value left? And the answer is, well, it depends on where we're going to go from here. Certainly, there's a tremendous amount of liquidity in the system, a lot of demand, and that's particularly true in fixed income markets in the U.S., where there's still some positive real yielding assets out there.
So this is the conundrum right now. I mean, people are looking at $17 trillion of negative yielding debt, a record high globally. We're looking at yields that are historically low in the United States, even as we look to increase deficits and spend going forward. And you have Morgan Stanley coming out and saying this can't last. People are optimistic about the future, and you're going to see yields rise. It's going to be tough to be in duration. Do you agree, or do you think that they have it wrong and that the overhang of debt is just going to keep growth so slow that yields here make sense?
I mean, that's the question. I mean, I think in the near term, we're certainly going to be grappling with the virus and you know, hospitalization rates rising and how that's going to affect the economic data. But if we take a longer term perspective, we have a pretty supportive market, right? Central banks are certainly not going to get in the way. We're still looking at more fiscal stimulus in various parts of the world, including in the U.S., probably in January. So, you know, it is a very supportive environment for financial assets. If you take a longer term look, I think that we are in a cyclical recovery phase, and we will start to see yields move a little bit higher from where we are now. But, you know, when you look out even longer term, we still are dealing with very, very large debt burdens, and it's hard to see an environment where yields get aggressively higher from where they are.
Lisa, what was the lesson from spring?
The lesson from spring was follow valuations, right? If you think about where we started this year in credit markets, for example, we came into it in the 10th decile or so. In other words, credit spreads were as tight as they've been for a very, very long time. And if you came into this year listening to that, you were relatively low on risk. And that set you up perfectly for what we saw in March and April, with spreads blowing out to basically their 90th percentile, 95th percentile over a long-term range. And, you know, if you were able to take advantage of that, you did quite well this year. And now we're we're kind of past that easy period in markets where, if you wanted to call it easy, where the easy money has been made, and now it's about getting the industries right, getting the issuers right, looking at sectors that are going to benefit from the vaccine going forward. And I think that there still are opportunities out there, but again, you have to let valuations be your guide.
Let me tell you, nothing felt easy about spring, and I'm sure it wasn't easy for you either, Lisa. The reason I asked this question is because I think many people don't think we will see spreads blow out again. There is this comfort with the Fed being in the market. There is this belief that so many people are conditioned by what happened after spring. Why step out? Because you're going to miss out on the levels. They're just going to go tighter. And I just wonder if that's the right lesson to take away from the experience of spring.
Historically, if you look back over time, the starting point certainly matters. And now I take your point, John, that perhaps we're in a regime now where spreads can move to the tighter end of their range and stay there for a bit longer. So you have to adjust your valuation barometer a bit. But at the end of the day, spreads are mean reverting. You are not, when you're not being paid to take risk, you shouldn't be doing it. That's certainly how the approach that we've taken to managing money, and certainly what we'll do going forward. So we will listen to what the price tells us. When there's not opportunity, we'll diversify away from corporate credit. We'll look at other areas like agency MBS. We're looking at things like taxable municipal bonds, where you still see strong fundamentals in certain parts of the market, and attractive valuations.
All right. Well, in credit, what doesn't look expensive historically? I mean, I'm looking right now at high yield bonds. They're yielding 4.8% at a time when we really do have slow growth expectations ahead.
So I think there's a couple of pockets. So first of all, you have the COVID-related sectors that are still trading cheap on an aggregate basis. There are companies within those sectors that are positioned to withstand the next 6 months of volatility. They have the cash flow, they have the balance sheet cash to insulate them, and they'll be able to make it through this period, and then they'll be poised to benefit from the cyclical recovery that we'll see on the other side. I think there's issuers within the aircraft manufacturing space, for example, within travel, within tourism, that fit that bill. I mentioned the municipal space. There are certainly universities are going to benefit. Airports are going to benefit when we come out on the other side of this. You need to look for the right issuers within those sectors. So airports, for example, with lots of cash on hand, with reserves on hand. But if you can find those names, and there are many of them, then I think you'll be poised to benefit on the other side of this crisis.
Lisa, John Templeton years ago predicted there'll be a shortage of bonds. I would suggest the greatest surprise as we end this nuts year is the idea of the expansion of debt, and yet we still feel there's a shortage of bonds. Is there a shortage of bonds?
It sort of depends on how you look at it, I suppose, but certainly yields would tell you, which continue to amaze us, right, that there's still a tremendous amount of demand out there. I mean, I focus primarily on the U.S. markets, and overseas investors still benefit from buying U.S. dollar-denominated yields relative to their own home markets. So from that perspective, I suppose you can say, yes, there's not enough of them, because if there were, we'd see yields moving higher and not lower, despite debt loads increasing across the board.
Lisa Hornby, thank you so much. Greatly appreciated today. Lisa Hornby with Schroeder Investment. John, you were way out front on this, and I remember Greece and particularly Italy, where people can rationalize to me debt irresponsibility, and yet, am I right, John, that as a basic European 2020 statement, it was price up, yield lower?
Absolutely, and largely because of the ECB's involvement in the market. Also, just the momentum behind some of these trades. The interest costs as a percentage of GDP have declined for many of these big countries across Europe, Tom. The interest rates are very, very low. You asked the question, have we got a shortage of bonds? Depends who you ask. If you ask the central banker right now, looking at Germany or looking at the United States, they might actually say, yeah. If they wanted to ramp up QE in a massive way, they've got to issue more debt in places like Germany. And dare I say, some people might make the argument that in the United States as well.
I mean, I think this is really, really important. Lisa, I know you're developing a program for 2021, the real high yield. But, me as the amateur, I was really taken back by 4.8%. You got to be kidding me. Well, high yield garbage is 4.8%.
Yeah, and this is one of my fundamental questions. How much of a Fed backstop is this really baking in? I mean, John keeps asking the question, what did we learn in March, right? And the answer for a lot of people is a Pavlovian response that if things get tough, the Fed's going to come in and bail you out. Is that the message that we're hearing right now? And this, to me, is the key, Tom. Is that the message in high yield bonds with yields of 4.8% at a time of slowing growth, at a time when companies are closing their doors, and a time of a very uncertain future, despite the fact that we will eventually get a vaccine? Tom.
I think she's talking to you, Tom.
Did he? Tom, you still there?
She's talking to you.
Tom.
I mean, if it's bond talk, it's you two. Look, if it's bond talk, I check out, okay?
You brought it up. You can't bring it up and then check out.
I brought it up because you two are actually really smart at this. John, continue this. 4.8% high yield. John, I remember when a high yield piece under 8% was like suspect. I mean, come on, John.
How do you expect a market to discount risk when it has a price-insensitive buyer in it?
I agree. It's artificial.
How do you expect it to do that?
It's how does an institution...
Everything about it is artificial.
Lisa Hornby, how does Lisa Hornby structure a portfolio with a 5-year vision with this elephant in the room?
But here's the thing. The Fed is not going to backstop solvency, right? At a certain point, the Fed will step away. And at what point will that happen, John?
Will it? Will it?
Yeah. Well, I mean, they're not going to bail them out from bankruptcy.
No, I don't think they are, but I don't think the Fed's ever going to step away from the credit market. The ECB's still going for it. The BOJ's buying ETF equities. That's where the BOJ's been at for the last several years.
Italy, negative yields.
Yeah, there you go, Tom. Futures down 1. It's much more exciting than that, I promise you. Coming up on this program, Dr. Jonathan Quick of the Rockefeller Foundation from London and New York. This is Bloomberg.
With the First One News, I'm Rishka Gupta. The Trump administration has assured states they'll have enough hospital beds and equipment to handle the surge in coronavirus cases. But it's not doing anything to slow the virus's spread. And the Trump team continues to shut out Joe Biden's advisors. Vice President Mike Pence says the media have been crying wolf about the disease. And the job picture in the U.S. has gotten worse as the number of coronavirus cases rises. According to the Census Bureau, the number of employed Americans fell by about 4.5 million from mid-October to mid-November. Amongst the jobless, 4.2 million said they were sick with coronavirus or caring for someone with symptoms. New York City's prospects of recovery from the coronavirus face a double whammy. The subway system could be crippled by big budget cuts unless Washington comes to the rescue. Plus, public schools are ending in-class instruction for at least 2 weeks. That's forcing parents to find alternative childcare arrangements or adjust their work schedules. The so-called Five Eyes intelligence partnership has called on China to live up to its duty to the people of Hong Kong. That's after Beijing demanded loyalty from the city's lawmakers. The Five Eyes consists of the US, UK, Canada, Australia, and New Zealand. The group urged Beijing to quit undermining the rights of Hong Kong residents. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
What's always been important for us is to understand, why is there something in your DNA that makes you more likely to, be susceptible? We have a large community of individuals who said that they did not have COVID, where we have their DNA. So we are looking to work with pharma partners about, can we help with treatments?
Anne Wojcicki there, the 23andMe CEO and co-founder, alongside Tom Keene and Lisa Abramis. I'm Jonathan Ferro. Good morning to you all. Thursday morning, jobless claims 42 minutes away, 42 minutes away rather, as we count you down to that data point, an important data point increasingly over the next few weeks with this economy slowing down. In the FX market, euro-dollar down to 118.35, stronger dollar story through G10, through EM. S&P 500 futures down about 2 points, no drama here. And in the bond market, down about a basis point to 0.8586%.
A pause within the November drama, John. Let's get right to it here on the pandemic, and this is definitive. There's lots of people managing the message right now. That is something Dr. Jonathan Quick has never done. He's with the Rockefeller Foundation and is definitive in thinking about epidemics. His book, The End of Epidemic, is truly the Bible on these modern processes. Dr. Quick, thank you so much for joining us. How does a pandemic end? You and I really haven't lived one. I mean, there was a cholera in '67, I recall. But actually, how does a pandemic end?
So, I mean, it's basically like a forest fire. And it either ends when it runs out of wood, which is us humans, or it ends when there is a response, basically dumping water all over it, which is what a safe and effective vaccine would do. And those are the two ways that it can end. And right now, the good news is that we have seen, I think, just remarkable news on the vaccine side. But at the same time, we're letting that forest fire run uncontrolled in this country.
And Dr. Quick, I say this with great respect for all watching and listening that have suffered this personally, particularly the essential workers and those that have lost older loved ones. Is the reason it maybe doesn't feel as angry as April or May because we've killed off so many old people? Is our pandemic demographic now different than it was in spring?
Well, it is different than it was in the spring, in the sense that overall we're seeing fewer deaths per case, because it is become a pandemic across all generations, and we're seeing more of the youth. But I mean, the reality is that we still have tens of millions of people who are at risk. And I think we need to understand the consequences of the inaction, because it's not just the fact that we're on a pathway to hit a deaths of nearly 500,000 people over 400,000 people by March if we don't do something. That's one part of it. The other is millions of people who've had COVID who are going to have the lingering consequences. We saw with the SARS, the first COVID that went global in 2003, and we're seeing it again today, that perhaps a quarter of the people have lingering disability. Not to mention the fact that letting this go out of control, people are not going to feel safe going out. They're not going to feel safe in schools. So I think we have a real challenge by just letting it run wild. And we know what to do, and it doesn't involve crashing the economy.
Well, hold on a second, because you say about the long-term effects, you talk about how it's not just the deaths, it's that the prevalence could have ramifications far beyond even our comprehension now. We have a 250,000 deaths here in the United States. The real issue is we don't even know where people are getting the virus at this point. Has track and trace died at this point, given how pervasive COVID has become?
Yeah, I mean, the track and trace at this point is going to be less important in the majority of places that are having it. That's not true, though, in more focused settings like schools and workplaces where we still have some opportunity. But overall, the key thing is a handful of core actions. Everybody mask, restrict or suspend dangerous indoor places, limit gatherings over 10, stay home if symptomatic, businesses provide leave, and government help support business. I mean, it's not complicated, and we can't choose. It's not like it's a menu. You choose one or the other. What we know clearly from 1918 and again now is doing all of these things together until we have bent the curve. And we can do it, and we can do it without crashing the economy.
Dr. Quick, this is an essential point, because some people will look around and say the death rate is low, even when we have a pervasive virus. Why not let it go rampant? Why shut down my social life? Why increase the incidence of depression and the widening gap and inequality and a whole host of other issues? What would you say to those people about some of the restrictions that have been coming out, basically saying these are harming us more than helping us?
So I think the thing is to be focused with our restrictions, and recognize that yes, there is going to be some short-term individual sacrifice, but it's going to pay off for the long-term collective welfare, because we're only accelerating. I mean, when you're getting up to death rates of cumulative death rates of 400,000, but it's the total effect of that on society. So it's really taking a short-term sacrifice for the collective long-term benefit.
And really concerning numbers, Doctor. We've got to leave it there, unfortunately. Appreciate your time, sir. Thank you. Dr. Jonathan Quick there of the Rockefeller Foundation. We appreciate your time and look forward to getting you back soon. I want to bring you some headlines from United Airlines, and I think it's important to recognize not just the COVID increase, the rate increase over the last few months and the policy response to that, but also how consumers respond to this as well. United Airlines noting a deceleration in system bookings in the last week, an uptick in cancellations from the recent COVID-19 spike. Tom, pretty clear how consumers are starting to disengage just a little bit more, regardless of whether the policymaker steps in or not.
Yeah, Air France out with a set of brutal headlines as well today, and that's a different battle. There's government intrusion there, and maybe the Dutch have to do something off of KLM, Air France as well. But, John, you're absolutely right, and what's important in those headlines is the last 5 or 6 days, they really allude to a present slowdown.
Well, from Air France, Tom, you know Air France, the capital raise situation. No urgent need right now, but that's the direction of travel, looking to raise more capital. I caught up with Guy on this topic in the last couple of days. Guy follows the airlines very closely for us here at Bloomberg. And Guy Johnson was basically saying this is the problem for anyone who's long some of these stocks, Tom. Will they be using that rally for an equity raise, a cash call at some point in the next quarter. That's the issue.
Well, they come off the bottom, and I agree. You see share dilution and bond dilution, frankly, to everybody that's already in the game, including the governments. But what if they roll over, John, off of the duration to get back to business travel?
That's a question for Jeff Yu. He comes up very shortly on this program. BNY Mellon's senior strategist. Looking forward to that alongside Lisa Browitz and Tom Keene. I'm Jonathan Ferro. For our audience worldwide, heard on Bloomberg Radio, seen on Bloomberg TV. This Thursday morning, this is Bloomberg Surveillance.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
We're in a much worse place today than we were in the first half of October.
We've seen a massive momentum shift in the last week that we don't think investors should be ignoring.
You're not going to get a continuation of this straight upward movement.
there will be pullbacks.
In the very short term, we are very much due for a tough time.
The Fed has been quite clear that they expect the federal government to hopefully provide more income support.
What they really want is for Congress to do its job, and that's not happening.
This vaccine news is game-changing. It gives us a bridge to somewhere for policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. On a quiet November morning, the IMF is direct. There is real risk to any form of international recovery. They look at the pandemic data, they look at the GDP data, and they look at the lack of fiscal stimulus nation to nation. And Georgieva and the rest at the IMF says this time is different. John, these headlines are original. They're before a G20 meeting, but we got to get right to this, John. This is a real wake-up call of the immediacy into December.
It's an echo off the words of Chairman Powell, President Lagarde over the last couple of days as well, the risk that we lose momentum. And I think this market and market participants are very quick to untangle the short term from the long term, to bury their heads in the sand of hope back in the back end of 2021 and ignore the risks that are emerging in the short term. And I think what policymakers are trying to suggest, what they are suggesting, is that the short term matters. It can shape what the long term looks like. And those risks, when you look at the balance of risks, they are tilted aggressively to the downside, Tom.
We thank Gita Gopinath for joining us at the Bloomberg New Economy Forum here in the recent hours. Lisa Abramowitz, this headline, elevated asset values point to financial stability risks. And that's I'm surprised that is a judgment by IMF on where fixed income and equities are.
Well, this is something that's been a consistent theme throughout the past decade, frankly. Central bankers prop up asset prices, then worry about said asset prices. The question is, how far are they going to go? I know that the Federal Reserve has actually come out and said that they are looking at the shadow banking industry, hedge funds in particular, about how much leverage they use and their role in some of the March turmoil. But the question is, how far will any of these central bankers, will any of these international agencies be willing to go, Tom, at a time when we've got such fragility in the underlying economy?
John, we focus on something like the International Monetary Fund, or frankly OECD, and we talk about EM and South America, other nations as well. John, any judgment of this pandemic is Eurocentric. The greater sprawl that IMF and other institutions see, and they mention it within these headlines, of an EU flat on its back from this pandemic.
President Lagarde was really cautious this morning as well. She delivered a speech to the Parliament. She said the following: companies are likely to remain hesitant about committing funds to long-term investments as long as there is continued high uncertainty on how the pandemic will unfold and the rollout of a vaccine. Policymakers aren't trying to get ahead of this, Tom. They understand the risks in the near term. But the complaints about financial stability just makes me shake my head and laugh. The policy objective was to divorce financial conditions from the underlying economy. That was the objective. They've been successful doing that. You can't complain about the spread in the months afterwards. That just doesn't make sense.
This is a really important insight, folks, and gets us perfectly to our esteemed guest this morning. Futures -7, Dow Futures -74. I'm going to lose a data check here because this moment with the IMF is so important. Jeff, for you, John Farrell nails it with BNY Mellon. Jeff Yu joins us this morning. And Jeff Yu, the risk here is that government becomes so intrusive, as Japan did, that we almost have zombie full faith and credit. How at risk are we that well-meaning politicians can Japanize their portfolios to becoming zombie-like debt?
Well, a lot of that will depend on, what you feel is the institutional link between the corporate space and monetary policy and government policy, right? So I would say in Japan, the link between the private sector or the corporate sector and government perhaps is stronger than it needed to be when these debts were crystallizing. So the onus for Europe and for the US is to make sure that that link, between the corporate and the central bank doesn't go in that direction.
Well, Jeff, let me jump, because I know John and Lisa want to get in here. Jeff, let me jump to the core issue, which is the pernicious and negative interest rates in Europe. Do you risk a zombiness a la IMF headlines if you have persistency of negative interest rates?
you only risk a zombiness if there is no growth, right? So if there's no other way to grow, to help banks make money through their margins again, through a steeper curve again, that's the point. It doesn't matter about the front end, as long as there's a curve, a steep curve for banks to actually grow their way through the balance sheets out, then it's okay. That's the risk for Europe right now. If there's no growth, then negative rates or very low rates are going to be here to stay.
Jeff, basically what you're saying then is that this central bank can't engineer a steeper curve. This central bank is the reason we have a flatter curve. Is that fair?
So here it becomes a chicken and egg story. You could argue that corporates, who need a flatter curve, they actually discovered, they might like, free to the negative, based funding that central banks have discovered, and then central banks have maybe discovered, okay, if we have an entire industry or credit that's actually dependent on this, then they are stuck. So again, how do you get unstuck? How do you actually kickstart the economy again? Here's where NGEU comes in. This is something that Europe is desperately trying to move forward, but now once again it's being held up. So no, that's going to be the crunch point for Europe up ahead.
So meanwhile, IMF is saying that there are financial stability risks. Other people would agree, and yet it's hard to see that when you look at the VIX, when you look at the MOVE index, these other gauges of potential future volatility. What is the key financial stability risk as you see it based on central bank intervention and based on the current outlook?
Right. So are we going to see default rates, go up? Fundamentally, that's going to be the question, especially for the banking system. If we talk about financial stability risk, I think liquidity risks pretty much have been taken care of, but it's going to be solvency risk. Solvency risk means, very sharp rise in defaults. And even if you look at China, where it's supposed to be going up again, the latest financial stability report coming from the PBOC, they are concerned. You could see a tenfold rise in the NPL rate, for example. It's right there on paper. So if that happens in a supposedly good growing economy, then of course everywhere else, all the other central banks, they need to monitor this. So again, how do you get growth in place to actually avoid bankruptcies coming through government support, through a vaccine? This needs to happen very, very quickly. By this time next year, I think we need to do a double take on where the NPL rates are and hope they're not materially higher than where they are right now.
Jeff, let's get you in trouble. We can try and do that, at least for 60 seconds. I woke up this morning, I've woken up a few times this week and heard the word default and China and credit in the same sentence. What's going on over there?
Right. So what's happening right now is very isolated to state-affiliated enterprises and their bond markets, right? So this, let's be clear, is something that China has been trying to do. The regulators have been trying to introduce risk pricing into bond markets, into credit markets. The chief regulator, Mr. Guo, he's been saying this for a long time now, so be aware of the red flags. So this is a repricing that's going on, which is very, very necessary, but at the same time, I'm sure China can keep things in check for the time being. And going back to the long-term view, as long as there is growth and there is a plan for that, hopefully the risks can be contained right now. But for now, it's all part of the plan.
Jeff, what do you glean from five-year forwards? They've rolled over. There's a whisper of disinflationary intent there. Is it real?
It is real, and right now, even in supposedly the good places, where there is reflation, central banks are worried. So look at what happened in EM in Asia overnight. You actually saw Philippines, Indonesia cut rates against expectations. Both central banks said inflation is a bit weaker than they expected. So even in the good growing economies, supposedly in Asia, where there is reflation driven by China, they're worried about disinflation. So what does that say about Europe and the US? We're still in the midst of the second wave. So that is happening, and you're going to see inflation expectations tame for some time.
So just to wrap this all together, Jeff, final question from me. Do you think we have reached the point where central bankers have run out of room to stimulate, that basically we've reached the point of diminishing returns where when they act, it's actually counterproductive?
No, and no central bank will ever say, they have run out of room. But I think there has been a clear shift away from negative rates. They don't see any marginal return from negative rates. I think that part is very clear. We saw the RBNZ and BOE move away from that. But in terms of further yield curve control, further twists, and just moving, so sticking around with yield curve, with quantitative measures, they're absolutely not out of room. And they'll continue to innovate, to look for new ways to apply. There is conviction moving forward to get economies to reflate, but at the same time, we need fiscal stimulus, and I think all eyes are on the US right now. If that comes through, it really will give the world a fillip.
Well, right now, the Senate is not at home. Jeff, great to catch up, sir. Jeff Yu, from BNY Mellon. Thank you. For our audience worldwide on Bloomberg TV and radio, just moments ago, the IMF Managing Director weighing in with a blog post ahead of the G20 meeting and saying the following: the recovery might be losing some momentum, the risks are piling up, they remain very high. But here's a headline we did not touch on. They must prepare for a synchronized infrastructure investment push. Now, Tom, we haven't seen much at the G20 level over the last 12 months. The science is the same everywhere, apparently, but the approach has been very different from Europe to the United States to China. But when it comes to fiscal policy, I do wonder, Tom, can they all get on the same page and do the same thing at the same time?
One day on a cold winter morning in Davos, the Bentley was down, and so I had to take the bus that goes along Promenade. John, you know the bus on Promenade. So I'm waiting for the bus on Promenade, and I'm watching all the buses go by me at Davos, telling me that we're going to have infrastructure in Azerbaijan, infrastructure in London, infrastructure. Where is it, John? I mean, I know it's out there in a lot of other countries, but the crying need for infrastructure has been there for well on 8 years, even 10 years.
They need to clear the ice off those roads, Tom. That's only part of the story. You waiting for the bus, me walking down the hill and slipping and almost breaking my leg that year.
I think I'm shedding a tear. I think I'm shedding a tear.
They need to sort the ice out.
Every year, every year a laureate goes down on the ice. It's actually very serious. And folks, it's wonderful to see, Pharaoh, everybody's got the spiky things on their shoes. Pharaoh just brings his old soccer cleats from, years ago, and he's, running around with those on.
Davos problems, small violins all round.
I mean, really, I feel the tears just dripping. I feel for you guys.
No Davos this year.
And Lisa Abramowitz. That's good. I'm pleased about that.
No Davos in the summer.
I'm happy to skip it. I'm happy to skip that too. You're not going to that. You're not allowed to go to that.
I can't go anywhere.
I thought there was a summer Davos.
I'm hermetically sealed in the surveillance room here.
Watching the buses go by.
Great news. Great news. Futures negative 0.1%. Jobless claims 20 minutes away. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Joe Biden warns that the delay in starting the presidential transition could set back the efforts to distribute a coronavirus vaccine. The General Services Administration has refused to begin the transition process whilst President Trump challenges election results. The leaders of the National Association of Manufacturers is urging the Trump administration to begin working with Biden. In Wisconsin, election officials have ordered a partial vote recount that was requested by the Trump campaign. There will be recounts in 2 heavily Democratic counties. Joe Biden won Wisconsin by more than 20,000 votes. Recounts have historically shifted only hundreds of votes. And the controversial nomination of Judy Shelton to the Federal Reserve Board is hanging by a thread. And there's little chance it will be revived. The Senate is preparing for its Thanksgiving recess. Once lawmakers return, Democrats will be picking up another seat. That makes confirming Shelton an even tougher battle. The city of Phoenix has approved a slate of incentives for Taiwan Semiconductor's planned $12 billion chip plant. Phoenix will provide about $200 million to develop roads and other infrastructure. Getting TSMC to build the factory in the U.S. is a step towards addressing national security concerns about the industry's supply chain. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
From London to New York this morning, good morning to you all. My apologies for the late pickup there. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. We are about 12 minutes away from jobless claims in America. Your estimate about 700,000. Want to go through the price action briefly, just to get you up to speed on how we're positioned going into that data point. Very, very important. The hope that things will improve through 21. We've got to grapple with how much things will decelerate in the months to come. In the bond market, 0.8554% is your yield on 10-year. We come in a single basis point in foreign exchange, euro dollar 118.34. Dollar stronger today in G10 and against emerging markets. And just to wrap things up, Tom, a quiet morning so far. We welcome quiet mornings sometimes. We're down 3 points on the S&P 500, negative about a tenth of 1%.
Yeah, what's amiss with you, John? For a moment there, I didn't think you were there. I just was worried about it, John. But
well, I considered stepping away.
Yeah, well, okay. I'm looking at this, and I'm seeing a little bit of an improving tape here. And, John, I want to emphasize this, and correct me if I'm wrong, but when we see macro thought-producing headlines like IMF, we assume, folks, they're not always directly linked into market response. I mean, we haven't really seen a market response.
The thinking of the IMF is very much in the tank for most people at the moment. It's about the near-term risks. I think what people are trying to grapple with is how much those near-term risks materialize and pull down potential growth in the future, regardless of the vaccine rollout that we all hope will come imminently, Tom. I don't think you can really separate the short term from the long term. The short term, if we do real damage in the next couple of months, that can do damage to the outlook as well.
And even more damaging is British economics, where Farrow had to learn the medium term, which is ignored in the United States to a great extent. Professional on the short, medium, and long term of our American politics. Leslie Vinja-Murray with Chatham House, head of the U.S. and America's program. Leslie, I love that idea of short, medium, and long term. What is President Biden's short, medium, and long-term gain to get to January of next year?
Well, I think right now the Biden team, and it is quite a remarkable team effort as we're seeing, is focused very much on the long game, and that is all about the pandemic, delivering a clear message and preparing to be able to deliver a very clear response, both on the health side and on the economic side, and trying as much as possible to keep to the side this very dramatic moment in America's politics, where despite a 6 million vote lead, despite 306 electoral college votes, President Trump continues to refused to acknowledge the result of the election, and it has launched those new challenges near Madison and Milwaukee, very Democratic areas, and trying to really cast doubt and undermine the credibility and legitimacy of the next president's term. So we'll see what results, but there are some bad polls. One recently suggesting that 77% of Republican voters recognize Biden's win, but don't think that it was fully legitimate, that there was electoral fraud. So this is very damaging, because, of course, the new president, President Biden, after January 20th, needs people to trust him if he's going to solve this problem, which is getting Americans to really comply, change their behaviors so that the pandemic can come under control and the economy can fully reopen. That is the name of the game. That's what Biden's focused on.
Biden certainly has an uphill battle on many fronts when he enters the office. We also have an uphill battle over the next couple of months as the virus continues to absolutely surge and decimate certain areas, including in rural areas across the United States. There is a feeling, and correct me if I'm wrong, but the Senate has entered a recess. It feels like they've thrown up their hands and cried, too politically difficult. There's going to be a vaccine. We're not going to do anything until we can figure it all out next year. Is that your sense as well?
I think my sense is slightly worse than that, which is that we are in campaign season. We don't know who's going to control the Senate. January 5th is what it's all about. You know, we've some interesting arguments coming out of those who follow Georgia saying there's too much focus from across the nation and across the Republican and Democratic parties on Georgia. Leave this to the people in Georgia. They know how to do it. But nonetheless, it seems like the country, certainly the political parties in the Senate, remain in campaign mode. And so really critical things. We all know how important fiscal stimulus is. We see leaders across the business sector calling for fiscal stimulus. Americans need it. It's a grim week ahead. It's Thanksgiving a week from today, and it couldn't be more important to so many Americans. But people are really suffering the health effects, the economic effects, and you're right, the Senate seems to be not standing up to its responsibility right now.
And Leslie, this is why the transition is so important. I have to admit, I did not know who the administrator of the U.S. General Services Administration was until the last couple of weeks. I'm sure many people shared that. Going forward from here, what is it that this individual, Emily Murphy, is doing that has been politicized? And what is it that in the minds of many people is just Emily Murphy doing her job?
Well, she's refusing to unlock the key, to let everybody into the executive, to let the transition teams, Biden's transition teams, into the executive arms of the government, to learn, to get access to that intelligence, to work with people who are currently in post, and to have the budget, right? There is a budget set aside to ensure the peaceful transition of power, which is the most fundamental norm in any democracy. Certainly in America's democracy, we have an incredibly complex system, as everybody knows. And she's holding it up. And it looks clearly to be very political. And in a position that somebody, you know, like her holds, which is meant to be anything but political.
Leslie, great to catch up. We appreciate your time this morning.
Leslie,
thank you. Leslie Vinjer-Murray there, Chatham House head of the US and Americas program. I think this is where the tension is in US politics, at least one place where there's some tension in US politics, Tom. We've got to work out how to cut this cycle. The last 4 years, there were many people in the Democratic Party who failed to recognize the legitimacy of President Donald Trump's presidency, and here we are going into this transition period, and on the other side, a whole group of people failing to recognize the legitimacy of a Joe Biden presidency. Yeah. At some point, that's got to get cut.
At some point it does, John, but the history of American politics is it doesn't. It goes on and on. The huge separation here that, frankly, you see in the percentage of the popular vote. I mean, I get the idea that 5 million is 5 million votes for Mr. Biden, but, I mean, you know, Mr. Trump garnered 40% of the vote. That's a hugely divisive America. Why should Washington change? I just don't buy it.
We need to push forward to the jobless claims data. 700,000 is the estimate. Tom, it is unbelievable to still sit here and talk about numbers as high as 700,000. Yeah. The amount of churn in this labor market, even before this deceleration, just phenomenal for all the wrong reasons.
I mean, Lisa, this is tangible, and we see it in New York City. But, I mean, do you remember 200,000?
200,000.
Jobless claims.
Jobless claims, yes.
Yeah.
I do.
Are you still with us, Lisa?
I am.
Thank you. Okay.
You're talking about way back when. I thought you were thinking about in the pandemic era because, frankly, 700,000 compared to what we were earlier. Yeah. Look, we are in a new era, and the question is how much scarring there. I sound like a broken record, John. I mean, save me here.
Has everyone checked out this morning? Seriously, Lisa Bramlett, Tom Keene. I'm Jonathan Ferro. Michael McKee will be on top of it.
Save us.
Bring us the data. 5 minutes away. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro, seconds away from important data in the United States of America, initial jobless claims. That means Michael McKee drops by the studio to catch up with us, our economics and policy correspondent. Mike, still waiting on the data.
Yep.
This data, just out right now, 742. The median estimate 700. Just go through the details for us, Mike, please.
Well, 742 is the number, and the forecast was for 700. So this is going in the wrong direction, but it is certainly not a surprise because people have been expecting us to see a rise in jobless claims with the rise in COVID cases. And, of course, a lot of bars and restaurants being shut down, gyms and things like that. We expected more people to go onto the rolls. Last month, 709,000. Let me see if there's a revision to that. It was revised up by 2,000 to 711. So we go from 711 to 742. Continuing claims, 6,372,000. That's a drop. But that's almost become somewhat irrelevant in the sense that people are using up their benefits. 26 weeks, they're moving into the 27 weeks, and that goes into the emergency unemployment category, and that was up by 233,000 to 4,376,000. So we are seeing a lot of people still getting benefits. They're just not getting them under the old continuing claims program. Total number of people getting benefits, though, falls by 841,000 to 20,319,000, raises the question of, are people going back to work? Or are people just dropping out of the labor force? One of the things about that total number, though, that's for the end of October. That's 2 weeks delayed. So we may see that rise again now with more people getting the unemployment claims numbers.
Michael McKee, I'm so glad you're here because you're such an IMF watcher as well. We've got these G20 headlines out of IMF. I know they're 30,000 feet. They're grim and all that. They're a bigger picture. I want you to dovetail this, Michael McKee, into all your great work on the importance of December when I read Heidi Shearholz at the Economic Policy Institute about the grimness of December for those on claims, those on benefits who are losing their benefits. Tell us about what's coming in December.
Well, that's an unappreciated aspect of all this. Most of what the CARES Act produced is going to expire on December 31st, including that extra emergency 13 weeks that I was just talking about. The pandemic emergency assistance goes away December 31st. Also, the pandemic unemployment assistance, which has 8 million people on it now. That's for gig workers and the self-employed. That goes away on December 31st. The eviction protections go away. Student loan forbearance goes away. An awful lot goes away at the end of the year unless it's extended by Congress, which is why it seems so disappointing to so many economists that there are no talks underway in Washington.
Mike, great to catch up, sir. Thank you. Michael McKee there of Bloomberg off the back of this economic data. A deterioration in initial jobless claims in America and a worry, a real worry, that things could get worse from here into year end. A hope that in the future, in 2021, things could get better. Two pieces of news in the last week, one from Pfizer, the other from Moderna. Moderna, the vaccine in development there with a 94.5% efficacy rating. We can cross over to the Bloomberg New Economy Forum now. It is Health Day for our forum, and we can listen in to a panel which does have on it the Moderna CEO, Stefan Bancel. At the moment, Dr. Wu is speaking, the chief epidemiologist of the Chinese Center for Disease Control and Prevention. Let's listen in.
We did a very bold decision. For example, when the outbreak first noticed by doctors, that's last December 27th, and the national experts arrived in the Wuhan, they made a bold decision to close the seafood market. At that time, there were only 40 cases, and 27 of them had exposure to Wuhan seafood market. Make that decision is tough, and the national expert and the local expert have different opinion, and the local expert has gone against to achieve that decision. Another decision is to shut down Wuhan City the decision was made in the January 22nd. At that time, we only have about 500 cases. That decision made had determined the scale of the COVID-19 outbreak in the whole China. The two decisions made, I think, is based on the philosophy, prepare for the worst scenario. Based on that principle, so we responded to the COVID-19 very quickly. We tried to remove all the virus from the community to clean it up and make the society safe. So now China, I think, is back to the zero local transmission now. Over.
Regina, I want you to come in on this too. What are you hearing from your network about kind of where we are in this process and in this cycle in terms of dealing with the virus?
Well, I want to calibrate for a moment because remember, the normal time to go from an outbreak to a vaccine is something like 5 to 10 years. So this achievement here is remarkable, unprecedented. The team at Moderna goes from virus sequence to first dosing in humans in 63 days. And as Stefan is fond of saying, that's an advance a decade in the making. In fact, I remember a decade ago when mRNA-based vaccines were first proposed. And the critics said there was no evidence to suggest it would work. And others said there is no evidence to suggest it won't. We should try. And if we are successful, it would matter. And here we are today. In fact, it matters. So I think what we're hearing now is how do we begin to work on the next pieces? So how do we shorten the clinical trial? How do we begin to get manufacturing underway so that we can couple the early warning with a rapid response? And there's still much more to do there. In my view, this is the Sputnik moment of our generation, right? And in the same way that Sputnik inspired a space age, so too might this pandemic inspire a health age. Lots to do.
You've been listening to the wonderful Regina Dugan there, the Chief Executive Officer of Wellcome Leap. That forum, that panel will continue along with Stefan Bansal and Dr. Wu, the Chief Epidemiologist of the Chinese Center for Disease Control and Prevention. This is the story that we're grappling with in this market right now. That conversation, the science, can you bet against the science, the hope that this vaccine gets rolled out in an effective way next year? The tug of war between that, the back half of 2021, and the moment we're in right now, with more restrictions coming through in the United States of America. And Tom, are we starting to see it in jobless claims? I know it's one data point, it's 1 week. That's the question we've got to ask week after week for the next couple of months.
Here's the way it works, John, and this is true of everything in economics when you have long, smooth curves. We've had a huge recovery in claims and down to a critical point where whatever moving averages you're using buttress up right against the data. The key thing is, John, we are there right now as we wait to see what claims do in December and January. That's a good precursor to bring in Nathan Sheets of PGIM. He is our fixed income chief economist, writing definitive international work for Citigroup a few years ago. And we're thrilled to have Nathan Sheets with us from PGIM this morning. Nathan, you know those curves, those Euler functions. Michael Woodford owns a high ground on this. We've got smooth curves showing us getting to recovery. Do you believe it?
I think the road to recovery is likely to be quite rocky, unfortunately. And I think, as was highlighted by the claims data this morning, the virus and the restrictions that are being put in place to fight the virus are likely to take a bite out of economic activity over the next, say, 3 or 4 months. Now, I think the economy is more flexible than it was in the spring, and we've learned how to respond to restrictions more efficiently and smoothly. But still, I think, save for the United States, Q4 and Q1 growth are going to be struggling to stay positive. If we get a small positive number, we should consider ourselves fortunate. So it is true that in the long run, once we have this vaccine, we hit that smooth curve that you described. And I think that the news on the vaccine is very encouraging. But especially without fiscal stimulus, the next few months are going to be challenging for the macroeconomy.
Nathan, I got to say, I'm sort of surprised at the market response to these jobless claims that came in worse than expected. It follows a trajectory, including the retail sales we got earlier this week, that also came in weaker than expected. The wave that we are seeing of this pandemic is hampering economic activity more than economists are currently projecting. Do you think that the scarring, the longer lasting effects of this uptick in the virus counts, do you think that it's going to have a deeper effect on the economy than people are currently giving credit to for 2021 and beyond?
The scarring question is one that's absolutely critical to think about. What are the longer-term impacts of this episode on the labor market and worker skills, on the small business sector and the capacity of businesses to produce going forward, and importantly, on household and corporate balance sheets and the willingness of folks to spend going forward? Now, on balance, my sense is that what's likely to determine the scarring most importantly is how long it takes to get the vaccine. And if we get that vaccine in the middle of the year, then I think that the scarring, there will be some that will be more limited. If somehow the vaccine disappoints, particularly, I don't think now the science of it is going to disappoint. Those results seem really strong. But there's still serious questions about distribution and about whether people will actually get the vaccine. So if the vaccine doesn't do what we expect, then I think the recovery will be much slower and the scarring is likely to be more intense.
And Nathan, so many of us were so wrong about how quickly the U.S. economy would bounce back, and it's bounced back really quickly. How do you model the second shock, though? When an economy goes through one shock, like the one we got back in March through April into May, how do you model the second shock when it begins to bubble away again before our very own eyes going deeper into winter?
One of the critical aspects of allowing the economy to absorb the first shock as successfully as it has was the powerful fiscal stimulus that Congress approved. And I think going through this second shock, this second phase of intense restrictions, with what seems to be essentially no fiscal stimulus, and as you were discussing, some of the other key safety net measures like the renters moratorium rolling off the end of the year, if that's where we are, I think the economy is likely to be more exposed. You know, on the other hand, as I said, I think that we're learning how to deal with this situation, and we're learning how to respond to lockdowns more efficiently than we were before. And so it's a competing dynamic, but without stimulus and without Congress acting on some of these safety net measures, it's going to be a rough ride into the vaccine.
Nathan, many people agree with you. Let me tell you that. Nathan Sheets of PGIM. This is what we're doing right now. We are operating on two different time frames. You've got the back end of 21, where we might have a vaccine effective, distributed widely, and we start to get back to whatever you think normal is. And the here and now, as we get initial jobless claims, just starting to build up again. Two things on this program, too. We can continue this conversation on claims. If you want to follow that panel that we touched in on, which did have the Moderna CEO, Stefan Bancel, on, you can do that at Live Go. The panel is Rebuilding Global Public Health. A lot of lessons in the last 9 months, Tom. A lot of lessons we need to learn from.
Oh, the lesson to me, and I'll be honest, John, all of us in New York are colored by the closing of the New York schools, and that's all understood around the bravery of essential workers within New York. But what concerns me, John, is the New York City schools are stories worldwide. I can make jokes about not walking dogs in South Australia, but John, look at the news out of Moscow. Overlay that with the IMF news, and then, as you say, overlay it with the short term. These pandemic events do have a short-term event.
You know what's amazing, though, Tom? The difference in approach. The same science, different approach. In Europe, here in the UK, schools are still open. They were the last things to close. The schools are still open. Well, everything else started to close down. In the United States, in New York, seems to be the opposite approach.
Johnny, acclaimed Benjamin Applebaum over at the New York Times had the tweet of the night last night where he said he's going to send his kids over to a restaurant today because it's safer than schools. I mean, it's funny, but it's not.
It's not funny. Coming up on this program, this isn't funny either. We'll catch up with Pat Foy, the MTA chairman, and the CEO. For our audience worldwide, this is Bloomberg Surveillance.
With your First Word News, I'm Rishka Gupta. The International Monetary Fund warns that the global recovery may be fading. In a report today, the IMF cautioned government against withdrawing stimulus measures prematurely. A resurgence of the coronavirus is leading to new restrictions on companies and households. The job picture in the U.S. has gotten worse as the number of coronavirus cases rises. According to the Census Bureau, the number of employed Americans fell by about 4.5 million mid-October to mid-November. Amongst the jobless, 4.2 million said they were sick with coronavirus or caring for somebody who had symptoms. The Trump administration has assured states they'll have enough hospital beds and equipment to handle the surge in COVID cases. But it's not doing anything to slow the virus's spread. And the Trump team continues to shut out Joe Biden's advisors. Vice President Mike Pence says the media have been crying wolf about the disease. And New York City's prospects of recovery from the coronavirus face a double whammy. The subway system could be crippled by big budget cuts unless Washington comes.
Ladies and gentlemen, I'm placing an order to sell short Swiss franc at 0.91259. Right at this price, yeah? Okay? Short position opened at 0.91259 on Swissy.
Unfortunately, as of today, on our 7-day rolling average for coronavirus positivity, New York City has hit exactly 3.0%. And as a result, we do need to close our schools for the coming days. No one is happy about this decision.
Good morning, everyone. On Bloomberg Television and on Bloomberg Radio Worldwide, and a special good morning to all of you listening on Bloomberg 1130 New York. The mayor of the city of New York, Bill de Blasio, and it's a story heard nationwide. Each story is different, yet they're all the same. With us now with immediate and essential labor perspective, Patrick Foy, MTA Chairman and Chief Executive Officer. Pat, I think you're lying to me. I'm going to cut to the chase. In no way do I think you're only going to cut 9,300 or 9,400 employees. What's the real number out 6 months if you don't get support from the federal government?
Well, Tom, 9,300 is the number of operating personnel that would be cut. We would obviously cut headquarters. Headquarters staffing is down 20% from 2019. There's more to cut there. Those people aren't involved in delivery of services, but we will be cutting. We've taken $2.8 billion out of the MTA's cost structure over the last couple of years. I would expect in 2021, apart from the service reductions, we'll take $700 to $800 million additionally. We're going to be constantly cutting and reducing our costs because that's the right thing to do. And the service reductions are on top of that. And the service reductions are staggering, will affect every New Yorker, every one of our employees. And the Rudin Center at NYU says it'll cost the region 450,000 jobs and destroy about $65 billion of regional GDP.
Pat, what's so important here is the conflation of variable and fixed costs. And you've got all sorts of realities, including complexity, including union relationships, et cetera. What do we most get wrong about the fixedness of your variable costs?
Excellent question, Tom. And I'll distinguish between subways and buses, right? Subways have extensive fixed capital costs that has to be maintained. And for instance, if you reduce service on a subway line from 100% to 80 to 60 to 40, you may be able to cut the number of train operators and conductors. None of this is anything anybody at the MTA wants to do. But the men and women who maintain the tracks, maintain the trains, communications, power, et cetera, will have to maintain that subway line regardless of whether ridership and the number of trains is 40 or 50% or 80% of normal. That is not the case in a bus system, because you don't have that great fixed cost. And that is, and obviously the operating leverage also associated with increases in ridership, increases in declines in ridership. You're spot on.
So, Pat, a lot of people may be listening to this program from Des Moines or Cleveland or El Paso, and they're looking at a Metropolitan Transit Authority that has $46 billion of debt, and they wonder, why should we be paying for the situation that currently is at hand? Albeit, this is an extraordinary situation, but why should it fall on them? What would you say?
So, Lisa, I'd say a bunch of things. For instance, you mentioned Cleveland. There's mass transit in Cleveland. There's mass transit in Austin, Texas, in Atlanta, in Washington, D.C., in Chicago, San Francisco, Los Angeles, across New Orleans, across the entire country. Blue states, red states, mass transit is incredibly important. It happens to be that the MTA carries about 40% of mass transit riders. So obviously, we're a larger operation with larger financial challenges. But every mass transit agency in the country has been affected by the pandemic, not to the same level of the MTA, given our ridership. On a typical day pre-pandemic, we'd carry 7.5, 7.6 million customers, largest in North America. But every one of the transit agencies in the United States is feeling the same pressure, and will have to take steps not unlike those that we're talking about. No one at the MTA wants to make these service cuts, because that's not what New York needs to feed the economic recovery, and it's not great service for first responders, essential employees, and our other customers.
And Pat, there's a question also about a downward spiral for public transportation, that if you don't have fast enough, reliable enough service, that people stop using it, and it just sort of begets even less service and fewer people using it. At what point does the MTA enter that death spiral that could have an even more profound effect on the entire region?
Look, I think it's an excellent question, and the Rudin Center's analysis took that into account. But you're right, Lisa. If we have to increase, for instance, headways, the time between subways and buses on weekends, to say 15 or 20 minutes, a lot of New Yorkers are going to determine that to get to the job, to school, to a medical appointment, or whatever they're doing, that it doesn't work for them any longer, and it does feed on its success. Success in mass transit and growth in mass transit increases ridership. Cutting it back also will cause some of our customers to say, you know what, it's not worth it. We won't get there.
I'm placing a stop on profit for Swissy at 0.91239. Okay, stop on profit placed. And we will see.
To the suburbs, Tom, but here's what I'd say. Cities like New York and London and Bombay, Mumbai, and others have survived, have gone through pandemics in the past. Obviously, the 1919 flu in the United States, which obviously had a significant impact on New York City. The movement to urbanization across the entire globe is a global phenomenon. The rise of cities as centers of talent and intellectual capital. New York City will be back. I'm bullish on New York City. This is a particularly tough time. 2020 and 2021 are going to be tough years. But obviously, with the great news from Pfizer and Moderna and the vaccines in the offing, that will be terrific news. New York City will be back after getting through the dark days of 20 and 21. No question in my mind.
Mr. Foy, thank you so much. Patrick Foy with the MTA. He's Chairman and Chief Executive Officer. Lisa, I look at the 47 things you and I can talk about to close out this hour. And to me, the great mystery is a mystery of the Fed to the December 16th meeting. Events are moving quickly, aren't they?
Yeah, basically the big issue is going to be whether they're going to give guidance about that $80 billion of asset purchases that they've been making each month. Are they going to extend the duration, the longer-term bond purchases, as a proportion of that overall portfolio? I got to say, what will be their reasoning, Tom? Because yes, we are looking at a bleak scenario, but what does that do in actual terms when you've got a 10-year yield at 0.857%? I mean, Do they want to push it down further? Are they concerned about how high yields are? What more are they going to do?
To me, Lisa, so much of this, and this is the great continental Europe-U.S. distinction and even United Kingdom distinction, there seems to be a massive distrust in America of throwing income replacement money to people. We just simply don't like to do that in America, and we did.
Okay, position closed on Swiss franc at 0.91239.
We're over that.
This is a hot button issue, and it's incredibly divisive, right? I mean, you've got some people, Andrew Yang, for example, a former presidential candidate, coming out and supporting some sort of universal income supplement, and other people saying, we're not socialists. You have to earn what you live on, right? I mean, this idea of pull yourself up by your bootstraps is also very American, but can people pull themselves up by their bootstraps during a pandemic, or if they don't have the resources or the education or the infrastructure or the public transportation? Key questions, Tom.
It's key questions, and folks, I would point out the calendar is moving along. Lisa, we're having a huge argument at home. I mean, for Thanksgiving, do I have pesto or not? I mean, we're there. We're to Thanksgiving right now.
That's where we're back to. We're back to the pesto. Go from universal income supplements to pesto and salt from,
Lisa, we're back to Thanksgiving, and the calendar is moving towards that December 16th Fed meeting.
Yeah, well, people are going to be looking to see what more support they can provide. But really where we should be looking, Tom, is down in Washington, where the Senate is basting their turkey, but they're not necessarily providing more support.
Well, it will be interesting. And that conversation driven forward by Michael McKee and Jonathan Farrell, Loretta Mester of the Cleveland Fed. You'll see that in moments here on Bloomberg Television. Stay with us through the day. Bloomberg Radio and Bloomberg Television. Good morning.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
From New York and London for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. Futures down 5. We begin with the big issue. Increasing infections, increasing restrictions, the pandemic jeopardizing the recovery, triggering new drastic measures across the United States. New York City closing its public schools and with no federal aid in sight, the city warning of massive cuts to its public transit service, putting another 9,300 jobs at risk. President-elect Joe Biden pushing to ramp up the transition process, saying the delay is risking lives.
I have no budget. I can't do any of this until I'm sworn in, or I can convince the president now to do things that should be being done already. I mean, there's hardly been a meeting that's taken place in the White House about any of this.
Meanwhile, the White House remaining positive. Vice President Mike Pence insisting the cavalry is on the way. The administration continuing to look ahead to a potential vaccine.
By the end of December, we expect to have about 40 million doses of these two vaccines available for distribution, pending FDA authorization, enough to vaccinate about 20 million of our most vulnerable Americans. And production, of course, would continue to ramp up after that.
Let's bring in the Bloomberg team. Joining us now is Bloomberg's Kevin Cirilli and Sarah Ponzek. Kevin, let's talk about this, the transition, the effort down in D.C. What's the federal response right now to a virus that in some places is out of control?
Two things. First and foremost, it's really being largely left up to the states. And you're seeing this play out not just in New York City, but also in states like Indiana. Yesterday, I spoke with Congressman Trey Hollingsworth, a Republican from Indiana, who essentially said to me that they are very much going to be relying on some of the federal aid that has yet to be deployed, not just to the cities, but also to heartland states. But the second point here is that the backdrop of the noise surrounding the transition between President-elect Joe Biden as well as President Trump, particularly on the briefings and a lack of negotiations on fiscal stimulus, is starting to bubble over more publicly. Yesterday, Senator Lindsey Graham, a Republican from South Carolina, speaking to reporters in the halls of Congress, saying, Jonathan, that he believes that the president should be also litigating and raising the concerns as it relates to the election, while continuing to brief on national security and the coronavirus with the president-elect's transition team. And so that is a very, very clear indication from establishment-type figures in the Republican-controlled Senate that they believe these talks need to be ongoing. And finally, very quickly, I would note that President-elect Joe Biden did speak with Senator Susan Collins, a Republican from Maine who won re-election. She is going to be one of the Republican senators who is going to be in the middle of the votes pertaining to fiscal stimulus, if not in the lame duck around the December 11th CR deadline, definitely after January 20th when President-elect Biden is sworn in.
Kevin, great work as always. Busy morning for you down in D.C. Yeah. The Senate's not there. They go home. They'll be back after Thanksgiving. In this market, we grapple with the same thing. Sarah, the tug of war continues.
It is a tug of war, but certainly right now, the tone in markets feels very, very different than it felt just last week, just on Monday. You think back to Monday, global stock indexes were reaching record highs. We had plenty of enthusiasm. You could really feel it over Pfizer and Moderna vaccine news. Well, since we have seen that fading, how long can you just continue to put up with these negative headlines that continue to come out day after day? You look at equity futures this morning, pointing lower for a third straight day. We see stocks lower in Europe, too. Really led lower by cyclical shares as well. That's a change from what we had seen just last week. Still, though, your VIX volatility remains sub 25. The key question has really remained, for how long can your long-term outlook, which is positive, especially with this vaccine news, how long can that outweigh the bad news? We have a miss on initial jobless claims today. We have more than 200 250,000 deaths now from COVID-19 in the United States. We have public schools closing in New York City. However, volatility markets don't seem too concerned about the near term. We have seen volatility just trend lower across the curve. Sure, we see a slight premium in January and December, but nothing too major. At the same time, if we switch up the board, just take a look at your FX and rates markets. We do see a very slight bid coming into the US dollar. This, though, after 4 days of losses and still trading near the lowest levels since mid-2018. And some Wall Street strategists now calling for a dollar bear market. The bond market, once again, just crickets. We've seen a slight bid, flattening bid, 85 basis points, but still nothing major. We don't see too much movement in the bond market, John.
Sarah Ponce, thank you very much. As Sarah points out, in many ways, the questions haven't changed. How much confidence do you have in 2021, and how much bad news will it take for that confidence to come undone? Sarah mentioned the initial jobless claims out 35 minutes ago. A couple of days ago, it was retail sales. Downside surprise, downside surprise. Retain the faith? Jonathan Golub of Credit Suisse says, do that. Expecting stocks to rally another 12% by the end of next year, preparing to kick off 2021 with an S&P 500 target of 4050. He writes the following: our 2021 forecasts are designed to answer a simple question. What will the future, 2022, look like in the future at the end of 2021? As we look towards 2022, the virus will be a fading memory, the economy robust but decelerating, the yield curve steeper and volatility lower, and the rotation into cyclicals largely behind us. Jonathan, great to have you with us on the program, sir. As always, you mentioned this in the research, your ability to de-emphasize the near term. How difficult is it to do that at a moment like this?
Well, you know, it's interesting, Jonathan. What you didn't read was a note that we put out 2 days ago, which basically said that in the fight between the vaccine and the progression of the virus was winning. And that we thought that the optimism around the vaccine was probably, perhaps too exuberant, and that the pickup in the virus is really a problem. And not to throw out big numbers, because that's just headlines. But if you're closing down schools, that means that you're taking lots of parents in places like New York City and Philadelphia and elsewhere, and you're forcing them to stay home with their kids and not go to work. And that's going to affect Christmas shopping. And if you start to close down stores and the like, you're going to have a really lousy December retail sales season. It's so important for retailers. So the near term, I think, represents a fair bit of risk. If I were a hedge fund with a 6, 8, 10-week view of the world, I'm not sure that I would be jumping in at this moment. If you're a pension plan or somebody thinking about the retirement with a longer term outlook, like you quoted, and I think that that's exactly the right way to think about it. When we get to the end of next year, the future is going to look beautiful. And that's what the market's going to focus on.
John, you should know me better. I read the piece from 3 days ago. I put it out there on Twitter, and I'll read some of it for our audience right now. If you're an investor with a time horizon no longer than Inauguration Day, we believe you would be well served by hedging the downside. That's your message. Your conclusion: for investors with a longer-term horizon, we're actually quite constructive. Jonathan, how many people do you think are just jumping to the conclusion next year, conditioned by what happened in spring, and not willing to miss out on a rally that gets too far away from them?
I'll tell you, I'm not a big user of, sentiment and flow data, but there's a lot of people who, who look at that. And when we're talking to investors, the level of exuberance has been off the charts. If you look at the AAII investor sentiment, bulls at reasonably all-time highs. We have, we're a very large prime broker, which means that we're very involved in the hedge fund business, and our clients have access to, hedge fund flow data, and we're seeing hedge fund leverage is up, and there's a lot of optimism there. And I think that that's a poor setup over the near term. Lots of optimism going into a shutdown. That's not a winning short-term strategy. But longer term, like we're saying, this is going to be a fading memory, and much sooner than we think. But near term, it's a problem.
John, where you're an outlier going into next year is your call on cyclicals, neutral on cyclicals. In the note that I read out, that paragraph, that the cyclical trade, that rotation, will be in the rearview mirror by the time we get to the back end of 21. John, can you walk me through your thinking and the kind of questions you've been fielding from clients on that particular topic in the last couple of days?
Yeah, you hit it right on the head. This was a a pretty unpopular call. Everybody thinks that industrials, materials, energy are just going to just massively lead the market. And if you look at energy in the last few weeks, it's up by 25%. So a lot of that upside is already happening. What the real call here is that banks were going to do, or financials were going to do much better than traditional cyclicals like industrials and the like. So we're neutral on those industrials, energy, material names. So the question is why? If you look at the purchase of physical goods, home building activity is strong. Auto activity is strong. People going out and buying, bicycles or using semiconductors, strong. But they are at a real peak right now. If you look at the ISM new orders, and for those of the Bloomberg screen, it's a great chart to look at. The ISM new orders is basically at all-time highs. It doesn't tend to stay there. And when it tends to come off of peaks, you have a bit of a sell-off or a lagging in those most cyclical groups. Now, if you look at financials, extraordinarily cheap, the most negative sentiment on their earnings and expectations for rising interest rates. And here I'm looking at, if you look at, again, I'm just talking about Bloomberg functions that I use every day, ECFC, where you can look at what are Wall Street economists expecting for interest rates over the next 2 years. They're expecting the 10-year to go back to 1.5%. And if it does that, that's just a home run for financials. So the real surprise, the real kind of nuanced call was, we're making a cyclical call. We just say it's going to sit in the banks, not in the people who make stuff. And that's just not the way that Wall Street right now is positioned.
John, just to be clear before we let you go, this bond market's not giving that banks trade a green light right now. Do you need one from the Treasury market for that trade to work?
Probably yes. I mean, that's I think there's a few things that work. First of all, the economy is still contracting year over year. I mean, the fourth quarter this year will be lower than the fourth quarter last year. But next year, the economy is in clear expansion mode. That means more people will take out a loan. That means fewer people will default on their loans. Those are good things for banks. Banks are basically the cheapest group in the S&P 500. That's a positive. But without rising interest rates, and I'm not talking about rates that are going back to 2 or 3%, but unless you get to 1.25 or something by the end of next year, the bank trade won't work.
John, great to catch up as always. No doubt we'll hear from you before year end. Jonathan Golub of Credit Suisse on the Outlook. Enjoy Thanksgiving next week, sir, if we don't catch up. In this market right now, about 19 minutes away from the opening bell, equities continue that tug of war. On the price action, here's Abigail.
John, so once again, an interesting divergence, this tug of war that you're talking about, and Jonathan Golub was just talking about really liking healthcare. Well, today, despite the worsening virus news and new restrictions here in the U.S., including public schools here in New York closing, we have the vaccine-related companies rallying. Let's take a look at the shares of Moderna. This stock is higher once again as their vaccine production is apparently gearing up, according to their partner Lonza. It, of course, was proven, or they're saying it's nearly 95% effective. That's the case, too, for Pfizer. These shares on pace for a third up day. Both of these companies planning to file for emergency authorization with the FDA. And then AstraZeneca today, as you know, Oxford University confirming that their vaccine works on older patients. As for retail, a mixed bag here. Macy's is trading lower after they actually beat with a narrower loss. They also put up better sales, but their online growth slowed to 27%. They're struggling. L Brands, though, climbing on Bath & Body Works, hand sanitizer, and soap doing well for that company, John.
Abigail, thank you. As we count you down to the opening bell, here's the line from Morgan Stanley. Keep the faith, believe in the recovery. Up next, on your faith in this market and that recovery, Matt Hornback of Morgan Stanley. From London and New York this morning, good morning. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
There's a short-term and there's a long-term narrative.
Bullish narratives and bearish narratives.
Investors are not optimistic in the short term.
This virus is going to make this winter very difficult.
Cases rising significantly.
They're hopeful about the longer term.
Think less month to month and more 12 months out and beyond.
The enthusiasm for 2021.
We can imagine a world where the COVID vaccine has been largely tamed.
This year-end conundrum, their longer-term fundamentals are there, but we have to deal with the rising case counts.
How much near-term pain, can the market really look through?
This tug of war. Investors have yet to decide which narrative they are going to go with.
Investors grappling, wrestling, weighing in on the virus versus the vaccine and whether the U.S. economy can withstand the near-term headwinds until a vaccine becomes widely available. Bloomberg's Michael McKee joins us now with some of the latest data. Mike, retail sales a couple of days ago, jobless claims this morning.
Yeah, John, the trend is not your friend. It's interesting to watch the markets, who are supposed to be discounting the future, reacting so much to what we're seeing in the present, because the present is not good news, but it's not a surprise to anybody. We have seen COVID cases rising, and along with that, if you're marginally attached to the labor force or if you are working in the service industries, you're in danger of losing your jobs. No surprise there. Jobless claims rise, 742,000, up from 711 the prior week. That's a slight revision higher. And continuing claims continuing to fall, even though what we're seeing is more people on the unemployment rolls because they're just moving from one program to another. And if you're looking at total numbers of people on the jobless rolls, that one is rather delayed, 2 weeks delayed. You can see it's still falling there, but now it should start to turn around as this all begins to bite the economy. And we got some other news from the Philadelphia Fed this morning along the same lines, in the sense that while they're still seeing expansion, 26.3 was the number. That's down from 32.3 the prior month. So Philadelphia Fed shows some declines in the total number of the business outlook there. Interesting numbers from the Philadelphia Fed, though. Really big jumps in prices paid and in prices received. If we knew anybody on the Fed who cared about inflation, perhaps we could ask them about that, John. And then we got to mention the fact that we have this fiscal cliff coming up at the end of the year. For the unemployed, this is bad news. They're going to lose the extra 13 weeks of unemployment. Unemployment for the gig workers and freelance workers goes away. The eviction moratorium, student loan forbearance, a lot of things are going to drop out of the U.S. economy. So if you're looking short term, unless Congress gets its act together, it looks like things are going to get worse before they eventually get to that better that the markets are discounting.
Michael McKee, stay close, won't you? Always enjoy this. Mike is going to stay close because a little bit later this morning, about 20 minutes or so, we'll catch up with the Cleveland Fed President Loretta Mester on the issue in the economy right now, inflation, and in this market too. That'll come about 9:40 Eastern time on Bloomberg TV and radio. Over at Morgan Stanley, the team still betting on a V-shaped recovery. Strategists there writing the following: greater clarity on vaccines and continued policy support point to early cycle dynamics and a supportive outlook for risk assets. Keep the faith, trust the recovery, and overweight equities and credit against government bonds and cash. Matt Hornbeck joins us right now. Matt, this is a tough time to try and keep the faith. Walk me through what would you test your confidence in the next couple of months, if anything at all?
Hey, thanks, John, for having me on. Yeah, I mean, it's the winter time is going to be a season of risks, but also we think rewards. Obviously, we've gotten some positive news on vaccines. Far be it for me to say that we won't have any further positive news on vaccines and distribution around them. But yeah, I mean, everybody acknowledges this is a season of risks. Can we get through it? You know, what kind of support are we going to receive from governments, from central banks? I mean, these are open questions. I'm not willing to become overly pessimistic until I see, you know, governments or state governments in the U.S. Take a stricter approach towards lockdowns. We are starting to see some evidence of nerves in this regard, but in terms of non-essential businesses, you know, the larger school systems around the country, we haven't yet seen the type of lockdowns that we were dealing with earlier this year. So I'm not willing yet to become overly pessimistic on that, John.
I am interested in what the threshold is, though, Matt, and you've given us a little bit of a flavour of that threshold for you. You're sticking with this V-shaped recovery, but surely you'd acknowledge that V, if you anticipate it still looks like that, is going to have quite a kink in it through the winter.
Sure. Well, sure, John. And I think, you know, it kind of depends on which economy you're looking at. If you're looking at the overall broader global economy, output levels have already returned to pre-COVID. So we're not just talking about the United States. Clearly, Europe is already in lockdown, but at some point, Europe will come out of lockdown, John, and the markets, being forward-looking discounting mechanisms, are going to have to consider what is the world going to look like when places like Europe are coming out of lockdown. So again, you know, yes, tough winter, absolutely, but we are looking to brighter days ahead, and the market, we think, will be discounting those as we make our way through the first quarter of 2021.
Matt, why do you think the bond market isn't? You're at 145 on a 10-year for next year. Right now, 86 basis points, and it's a struggle to break 1%. Why do you think that is?
Well, John, more recently, the elephant in the room has become the December FOMC meeting. I think one of the reasons why we've seen a bit of a bull flattening here is because there are some houses on the street that are calling for the Fed to extend the weighted average maturity of its purchase program. Quite frankly, John, we just don't see the logic in that at all, really. As best as I can tell, it's based on downside risks emanating from COVID-19 and the infections and hospitalization rates. But John, the Fed has known about these downside risks for some time. In fact, we all have known about these downside risks. And the Fed has been very vocal about being satisfied with the current stance of monetary policy. You know, it's just not like the Fed to use a blunt tool like bond purchases or rate levels to address near-term risks that eventually we are going to move beyond. It's just not like the Fed to do that. So we don't really understand the rationale for a duration extension in December.
Matt, we've got about 30 seconds left with you. What would you ask President Mester in 20 minutes?
Well, I think I would ask President Mester, what is the longer-term plan for the asset purchase program? You know, we have forward guidance around the level of its short-term policy rate, but we really don't have any forward guidance around its asset purchases. And I think the Fed would be wise to get that out there in front of the public in order to avoid a taper tantrum style increase in interest rates, which honestly nobody really wants to see at the Federal Reserve.
We'll try and tease that out in about 20 minutes' time. Matt, always great to catch up, sir. Wonderful work as always. Matt Hornback there of Morgan Stanley. Up next on this programme, your morning calls around the opening bell. We'll continue the conversation on this tug of war with Stuart Kaiser of UBS. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you? Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The opening bell just around the corner. Here are the morning calls. Citigroup upgrading Cody to a buy with a $10 price target. The analysts expecting COVID-related headwinds to start significantly subsiding. Okay. Next up, KBW downgrading JP Morgan to market performer 113 price target. The analysts seeing limited room for additional upside following the stock's recent outperformance. And your third and final call from the team at Argus upgrading Marriott International to a buy, a 140 price target. The analyst expecting recent vaccine developments to fuel an earnings recovery next year. That stock up by about 1%. Coming up on this program, full bull or room to run. Investors take their positions. That conversation up next with UBS's Stuart Kaiser from London and New York this morning. Good morning. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
The Bloomberg New Economy Forum brought together over 600 leaders to discuss the most pressing economic issues facing the world today.
Join us as we recap the important conversations from the week on our New Economy Forum special this weekend on Bloomberg Television.
we explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
It's a drip feed of bad news in this economy. Downside surprise on retail sales. The wrong kind of surprise on initial jobless claims. Drip, drip, drip. Can you keep working your way through that Chinese water torture through year end? Into next year, where things get better. Going into the open, futures negative, down 0.2% across the board here. Switch up the board. Things are weird in 2020. Michel Barnier, Brexit negotiator on the EU side, suspending Brexit talks as one negotiator tests positive. Cable lower, down by 0.5%, a 132 handle just on the pound against the US dollar. Into the bond market we go. The high last Wednesday on a yield, 97 basis points. We roll over by another basis point today to 0.8554%. That's the story in the market cross-asset this Thursday. Let's get to the market desk and get you some movers. Here's Abigail.
John, well, beneath those modest declines for the major averages, let's find some bigger movers. And starting off with the tech space, we have a bit of a divergence. So many divergences recently in this year. NVIDIA is trading lower, down more than 1% after the chipmaker actually put up a very solid quarter. They beat estimates, and actually it's well off of the lows, probably because of that beat. And overall, the outlook was strong. Data center a little bit weak, but net, it seems investors are tolerating it at this point. What they love, Sonos, this stock absolutely soaring up 21%. Huge beat and boost. Katie Huberty over at Morgan Stanley is bullish, saying that they hit a very positive inflection point, the stock being rewarded. As for the cyclical trade, if we keep it super simple and just take a look at a couple of the banks and energy, we are going to see, I believe, weakness, but not huge weakness. And actually, at this point, we have Wells Fargo popping slightly higher. JP Morgan, on the other hand, is down 1.1%. The yield curve coming in a little bit. Wells Fargo seems to be evading that. On the other hand, Exxon and Chevron down in sympathy with oil, and oil could be trading lower on these new virus fears and, of course, the new restrictions here in the U.S. And then finally, John, a bright spot. We have some more strength for cars. Tesla up for a third day, up for 20% over the last 3 days on the S&P 500 inclusion. Nikola is higher on speculation of a deal with GM, which is now down slightly, and then Ford up ever so slightly right now as they are launching an electric version of their F-150, John.
Tesla, what a rally this year. Abigail, thank you. 2 minutes into the session, the S&P 500 down 0.4%. Bottom of the pile, energy, real estate, the financials. Top of the pile, consumer discretionary. Relatively speaking, that's where the outperformance is in information technology as well. That's the story of the market on this session. The story of the market over the last couple of weeks, a tug of war. Rising virus cases taking its toll, bogging down market optimism, bolstered by a promising vaccine on several fronts. For more, let's bring in Bloomberg's Sarah Ponczek. Hey, Sarah.
Hey, John. And the key question is really, is this going to continue? Well, as the outlooks have started to roll in for 2021, really, investors do seem to be relatively optimistic. First, if we just look at the average strategist target for 2020 this year, right now, they stand too pessimistic. At the end of the year, expectations for our year-end price target of 34.20 on average, that is already 4% below where we currently stand. And I think we can all agree that 2020 has surprised many of us in many ways. The resiliency of key really there. At the same time, though, you look to 2021, right now, no, we don't have all forecasts yet, but that average price target standing at 4,400, that would be a gain of 10% from where we currently stand. I do want to point out, though, if you actually look at over history, typically, what do Wall Street strategists predict? A gain of 9 to 10%. So we are right in that ballpark. But say that price is correct, that we get to 4,400, or even just make it easier. Say that the direction is correct. We continue to see upside in the market next year. What is going to get us there? Is it going to be a continuation of what we've seen over the last couple of weeks? Cyclicals, value, small caps, or is tech growth once again going to take over? And if that's not the case, can we even see the benchmarks continue to move higher, given that so many have such a heavy weighting to tech? Right here, you see over the last 2 weeks, small caps and value leading. In fact, value on pace to outpace growth for a third straight month. Small caps on track right now for their best month since 2000. So we have seen these moves in a very large way. Now, why do people believe? Why do investors believe in this rotation? A lot of this does boil down to the fact that we see a recovery in the economy. The expectation is for a true turn in the market cycle. However, much of it also just boils down to plain old valuations. And this has been the argument for years now, that growth stocks have such a high valuation relative to value stocks, as you can see here, still the gap for forward valuation is near a record, that at some point you're going to see a mean reversion. However, some investors like JP Morgan say that we are going to see this conversion to the upside. We'll just see value stocks gain more than growth stocks and catch up, that we're not going to see this convergence to the downside, and therefore you can see it all head higher together next year, John.
Sarah, thank you. When was the last time that the consensus view was for stocks to decline over the next 12 months? The division right now is not at the index level. The real division is beneath the surface. Strategists attempting to see through the fog through 2021, forecasting the year ahead for equities. Jonathan Golub, Credit Suisse, weighing in.
There's a lot of optimism there, and I think that that's a poor setup over the near term. Lots of optimism going into a shutdown. That's not a winning short-term strategy. But longer term, like we're saying, this is going to be a fading memory much sooner than we think. The real call here is that banks were going to do, or financials, were going to do much better than traditional cyclicals. You have a bit of a sell-off or a lagging in those most cyclical groups.
That was Jonathan Golub around about 20 minutes ago on this program. UBS's Stuart Kaiser taking the other side of the trade, expecting the rotation into cyclicals to continue. He writes the following: while we don't expect a broad shift into lower quality value stocks, we do see a continued rotation into cyclicals, as well as regionally into emerging markets and growth sensitive markets as well. Stuart joins us now for more on the phone. Stuart, just add for that, if you can, you've been one of the more constructive strategists looking out to 21 relative to how conservative you've been through 2020. Walk me through your thinking.
Hi, good morning, Jonathan, and thanks for having me on. Look, I think Jonathan Golub mentioned two of the key considerations here. One is timing, and one is how you define rotation. And from our perspective, I think it's reasonably confident to believe that through the course of 2021, you are going to see growth improve. There's obviously a ton of risk concentrated in the short term. From our perspective, amongst what I would call varieties of rotation, we're much more comfortable being in that cyclical trade for that reason. With the caveat that I think for most of this year, we've looked at cyclicals as a high quality cyclical trade. So, perhaps not bottom fishing in low quality and deep value, but being more comfortable sort of shifting up the growth sensitive spectrum, as it were. So obviously a ton of risk here in the near term, but our view is, from a growth perspective, I think you can be much more confident with that move, though we are still quite skeptical on the value trade.
Well, let's talk about the growth trade and the secular story that's done so well, the secular growth story that's done so well over the last year or so, Stuart, and beyond for that matter as well. There are some people who thought that the vaccine would be kryptonite for big tech. Do you share that view, Stuart?
No, we don't share that view, at least over the next, call it 1 to 3 months or so. And there's a couple of reasons for that. One is, as you've highlighted throughout the morning, there's a ton of macro uncertainty out there, from the virus, from growth expectations, from stimulus expectations, and things of that nature. But you also have, I think, what I would call some real logistical challenges if you're trying to sell tech to buy value, particularly from a sector and market cap perspective. If you were to decide you wanted to buy value in the S&P 500, you would have to buy about 350 lowest value stocks just to reach 50% of S&P market cap. So in addition to kind of macro challenges, if you're actively trying to rebalance a portfolio in that direction, it is a major undertaking. And in our view, it's also a major undertaking of a portfolio that's been constructed over a 24-month period or longer. We don't view the large cap tech trade as simply a COVID trade because we think investors were actively moving in that direction already. Clearly, the environment we've been in has exacerbated that and pushed those stocks to outperform significantly. But from our perspective, simply having a vaccine does not change investors', I think, positive view on sort of large, reliable earnings growth companies. So, we do think it can happen, but I think it's going to take a while, and we are sort of not on board with the extreme rotation out of sort of high quality large cap tech leadership into value stocks.
What you said at the end there, just about the basic maths, is so important. Stuart, come back soon, please. Stuart Kaiser there of UBS. I want to head back to the market desk, get you some movers before we head over to catch up with the Cleveland Fed President, Aresta Mester. Abigail, what have you got?
John, let's take a look at some of the biggest names, because the biggest drags on the S&P 500 right now are big tech names, despite the fact that that could be perceived as safety as the virus numbers worsen. So we're talking about Apple, Microsoft, and Facebook. Not huge declines, but because the weighting is so big to the indexes, it is causing that tug of war to the downside that you're talking about. Apple could also be down for a second day after cutting their fees for the App Store. However, we do have the NASDAQ outperforming slightly, John, and not surprisingly, what's behind that is Tesla, up for a third day in a row, now up 20%, more than 20%, well, right about 20%, bull market qualification if it wasn't already in a bull market. Of course, on the S&P 500 inclusion, the fact that means so many folks have to index to it, plus just the optics of being in the S&P 500, a real cap in the feather for Elon Musk, plus his wallet.
Abigail, thank you. Thank you very much. Coming up on this program, a conversation you do not want to miss, an exclusive interview with Cleveland Fed President Loretta Mester. That's coming up next on this program on Bloomberg TV and radio. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
When you went to Baltimore, you went initially to be an
anchor woman,
and then didn't quite work out.
Yeah, I got fired.
Well,
well, demoted. I was
got demoted, but they didn't. They had a contract, so they didn't say goodbye.
Yeah.
And then, how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know with age and perspective, that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25." Then you're 30. So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000. Right. So they kept me on and said, "We'll put you on this talk show just to run out your contract."
For our audience worldwide, live from London and New York, joining us now on Bloomberg Television and radio, I'm pleased to say, is the Cleveland Fed President Loretta Mester, and of course, my good colleague and friend, Bloomberg International economics and policy correspondent, Michael McKee. President Mester, fantastic to have you with us again on this program. We've appreciated your time through much of 2020 as this economy and this recovery has continued. There is a real worry as we go deeper into winter about what happens with the momentum that we built up through the summer. Let's just start there. President Mester, what do you see and where do you see deceleration that concerns you right now?
Well, there's no doubt about it that you said it well. There was a lot of momentum. In fact, the economy had come back stronger in the third quarter than many of us had thought it would. The economy just proved to be more resilient than we had thought. Disparate across sectors, certainly some sectors that really need that face-to-face kind of commerce are not doing well at all. Other sectors are back to their pre-pandemic levels or even beyond. I'm thinking autos, I'm thinking housing. So that disparity is troubling. We knew that things were going to slow down after the bounce back in the third quarter, and we're seeing that in the data now. I am concerned about the lack of fiscal policy. If you look back to the beige book that we had going into the last FOMC meeting, and this is the compilation of all the contacts that we saw for prior to FOMC meetings, you'll see they had three concerns. One was what was going to happen to the virus in the fall. Two, who was going to be the next president of the United States, so election uncertainty. And three, what was going to happen with fiscal policy, because they were concerned without fiscal policy, things could get a lot worse. So one of those uncertainties has been resolved. The election uncertainty is resolved, but the virus case increase is very concerning. And the fact that we don't have a fiscal package is very concerning. So monetary policy, of course, has been, we've said we're using our tools. We're going to leave things very accommodative. We have interest rates at essentially zero. We have asset purchases, and we have our 13.3 facilities that are helping to get credit flowing to households and businesses. But with the disparate impact of this pandemic, that's where fiscal policy plays a role, because fiscal policy can be really targeted to households and small businesses that really need the aid, and to the states and local governments, which have taken on a lot of the burden here of helping. So I am concerned. Yesterday we had our Community Advisory Council meeting, and these are representatives that are really on the ground in low and moderate income neighborhoods. And there's a real need for housing, affordable housing. Food security is an issue that's becoming a little more problematic as the fall has gone on. And the virus, the case numbers are troubling. So you see states putting on restrictions, and even without states doing it, you can see in the mobility data that we look at that people themselves are being more restrictive in their activity.
There doesn't seem to be any sign that Congress is going to do anything, at least in the short run here. So does that mean you need to act, you need to do something at the December 16th meeting?
Well, I think we're in a good place with our monetary policy because we are very accommodative. I think the need is going to be a fiscal response, because they need to be able to shore up the firms and the businesses that are really being hurt by the pandemic. And as I said, you can see some parts of the economy are doing very well, and yet there's a lot of people still out of work. We have 9 million people. We're not even back to where we were in February. So, that disparity is really calls for a fiscal response. And if you look back at where we were at the start of this, the idea was to come in with strong fiscal policy, which happened, that CARES Act response, and with monetary policy working in tandem, right, to try to get people through that period where the economy really had to shut down because of the surge in the virus, to make sure that we weren't overwhelming our medical system. We're kind of back to those levels now. I mean, a lot of the medical systems in different parts of the country now are really under a lot of stress. And the idea that we're asking people to make a sacrifice again and not having that aid in place, I think is going to be really burdensome on the economy going forward, and certainly burdensome on the families that are bearing the brunt of the small business owners we talk to that are really, having to live now through some restrictions that they don't know whether they're going to come out at the end or whether they're going to have to shut down for good. And I think these things are related in the sense that if you were a small business owner or a person with a job that has to go into work, and you don't have that income security, right? It's hard to follow some of the restrictions. So, you may be taking a little more risk because I don't have a job if I don't go in. So I might have been exposed possibly to someone who had the virus. I'm not showing symptoms. I may go into work. Similarly, a small business, rather than, shutting down if there's a number of people who might have been exposed, they're going to try to stay open because they don't really have a choice in the sense that if they don't stay open, they're going to go out of business.
Well,
and so income support, I think, is needed for both to help them get through, but I also think it affects
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Love you too. One question that's been asked from people in fixed income markets at the moment is whether you would extend the average maturity of your bond buying. I don't expect you to give me a decision on that, but could you tell me if you see the benefits in doing something like that?
Well, I mean, as you know from the great financial crisis and the Great Recession, right, we went in and bought long-term assets to try to push down, right, the long end of the yield curve in terms of the yields there. And that's a tool of monetary policy. When we started the asset purchases in this environment, it was more about market dysfunction that we were seeing in the treasury market and the mortgage-backed security market. So the actual catalyst was about that dysfunction. So we were buying across the curve. Of course, those purchases also added accommodation, so they had a twofold effect. But you're right in the sense that there are things like, looking at the maturities that we're buying, clarifying our forward guidance on the asset purchases can be helpful. I'm a fan of, as clear communications as we can make them so that people understand our reaction function. So there are things like that that certainly would be under consideration. And that's going forward, we're going to have those discussions at our meetings.
Just because we're tight for time, is that something you would discuss at the next meeting? Because we do understand the reaction function around interest rates very clearly now. We don't on asset purchases. Is that something you need to clarify?
Well, I certainly am always a fan of clarifying our communications. And, at every meeting we talk about our communications. That's part of what comes out of the meeting, that statement that you see. So that's going to be a fundamental part of any FOMC meeting. And I can't say what will come out of the meeting, but I do think that it is an important part of how are we communicating our policy to the markets and do the American public understand why we're taking the actions we're taking, and including all of our tools.
You're doing a financial stability conference today. The last senior loan officer survey showed that banks were reporting weaker demand for business loans, and there were weaker demand and tighter standards for commercial real estate. Do we have a developing credit problem in this country?
I don't think so far, but I think that that's one of the things when you're thinking about a resilient financial system. It's twofold. It's obviously you don't want your banks to fail. You want them to be robust through economic downturns. But you also want the banks to be there lending through the downturn. And as you know, we took some actions early in the pandemic to try to ensure that the banks were there and able to lend to their customers and to households and businesses. So those actions were taken to